Check, check, my check, my check, 1, 2, 3, check. வருதுங்களா சார்? Check, check, my check. சார் இடம் யாருன்னா பிடிச்சு வச்சிருக்கீங்களா இல்லை எப்படிம்மா? அந்த பேக்ல எடுத்து கீழே வச்சீங்கன்னா வரவங்க உட்காருவாங்க. மேம், பேக் பிரதர் இங்கே இருக்கு. அங்கே யாரா வராங்களா? இல்லை மேம். மேம், மேம் வாங்க, இங்கே இருக்கு. அங்கே தான் உட்காருங்க. பிரதர். ஆஹா, நான் போயிட்டாங்க.
Good afternoon, everyone. Shall we start? What is your expectation? Sorry, we'll see. Okay. People online, am I visible and audible? Good afternoon. Srimati, Pemeshwari, Sheikh Mohammed. Good afternoon. Okay. I have no clue how long the class will last. I'll make sure it doesn't go beyond 6 o'clock. It might end a little early also. Nadakuma. Don't know. Okay. So I'll tell you, set the expectations of what the class is going to be about. Today, we are going to have a discussion which introduces you to the current budget. Attending the session does not mean you don't have to go and study budget after this. Let me be very clear about it. In 3 hours or 4 hours, what we can only give is a basic overview. We are going to cover I'm not just going to show and say, look at this, go and study. That is not what is going to happen. I'm going to go into a little bit of detail and explain, but still there's a lot more of especially scheme related details. You will have to go and learn deeper about it, because we are only we have only seen hints of it. As we see more and more the government explaining the budget more and more, that's when we'll actually get to see that in proper detail. Okay, so whatever is an overview of the budget, that's what we are going to be covering here. We will not be touching upon economic survey in this class. We will have a separate session planned in the coming weekends, where we'll have economic survey discussion, chapter by chapter, as much as necessary. If there is a relevant chapter, we'll take those up, and that is what the economic survey plan is going to be. So no economic survey discussion today. Okay. All right. So I need a little bit of assistance from my optional students before we can start with economic survey. Anyway, so we'll get into the discussion itself. We'll start with the most basic structural document of budget, and while I take up the budget document, I'll also do an overview of basic concepts related to the budget as well. For example, when I show you fiscal deficit, I'll also show you the formula related to fiscal deficit, so that it will act as a revision of the basic concept as well. All right. Start with the budget at a glance document. Okay, about 25 pages of document. So the first page, discussed it in quite a few classes with the previous budget. So the first page introduces you to the basic concepts of budget, what is meant by, say, deficits, what are the things that we'll be talking about, definition of fiscal deficit. So these are important because these are almost certainly going to be asked verbatim in the examination if they ask a question. If UPSC asks a question asking for a definition of anything, or match the following with the fiscal deficit, primary deficit, match it with the right thing, if those sort of questions are going to be almost certainly based on the wordings that are given here. Okay, where fiscal deficit is the difference between total expenditure and total receipts excluding debt capital receipts. Okay, that excluding debt capital receipts introduces us to the formula, relevant formula. What is the formula for fiscal deficit? Fiscal deficit is equal to total expenditure as is given over here, difference between total expenditure, so total expenditure minus total receipts excluding DCR minus DCR. So from the total receipt, if you exclude the DCR, what you arrive at is, you can also write this as revenue receipt plus NDCR, because we know total receipt is nothing but revenue receipt plus capital receipt, and inside that the capital receipt is made up of debt capital receipt and non-debt capital receipt. So except DCR means this would be the formula. Okay, but we also know that this difference is equal to what? Debt capital receipt, because the fundamental knowledge that we need to have with respect to this, the total expenditure will always be equal to the total receipt. The total expenditure will always be equal to total receipts. When a budget is presented, there must be balance between the two sides of the budget. Receipts and expenditure must be balanced. There is no way out of it, right? So total expenditure is equal to total receipts, which means what? If we are subtracting the DCR from this, the gap between that will be equal to the DCR as well. That's why we can also define fiscal deficit as the FD is reflective of the total borrowing requirement of the government. Whatever is the deficit, that much has to be borrowed. Without borrowing that, how will the government be able to take care of its expenses? So that is what this says. Then it talks about other areas. Revenue deficit refers to the excess of revenue expenditure over revenue receipts. Effective revenue deficit is the difference between revenue deficit and grants in aid for creation of capital assets. Then primary deficit is measured as fiscal deficit less interest payments. There also is another term called as effective capital expenditure, which in the previous budgets, I don't think they had explained it over here, but they have added it. I don't know whether this year or the previous year, but effective capital expenditure refers to the sum of capital expenditure. Whatever we are subtracting over here in effective revenue deficit, we are subtracting the grants in aid for creation of capital assets. So because we are saying, although it is a revenue expenditure, it is acting like a capital expenditure. So we are saying it is not to be treated as a revenue expenditure anymore. It will be treated like a capital expenditure. So we create a new concept called as effective capital expenditure and say to the conventional capital expenditure, we'll also add the grants in aid for creation of capital assets that will also be treated like capital expenditure. In fact, in this document later, the government has an analysis of the various receipts and expenditures, revenue receipt, revenue expenditure, capital expenditure. They don't mention capital expenditure. They mention revenue receipts, revenue expenditure in full, but they mention capital expenditure as effective capital expenditure, not as capital expenditure, because government has now decided that that is to be treated as capital expenditure. But technically they cannot write it as capital expenditure because it is not. That component, grant, right? Grant is a revenue expenditure. So instead of using the term capital expenditure, in all practical usage, the government is using term effective capital expenditure, which is why it is given over here. This explanation is given over here because that is now gained a greater prominence than just the term of capital expenditure itself. Any question? Any lack of clarity, let me know. Okay, at any point if you have a query, please raise your hand. I will wait for finishing whatever I'm discussing and then I'll take up your question. Just make sure that I see your raise of hand. I'll come back to you. Okay, if you have questions. Okay. Now, there's a point about it being net of recoveries. The actual amount is given over here. The previous year's the previous year's budget estimate getting revised and the budget estimates for the current year. Last year, the total receipt, total expenditure was somewhere around 50 lakh crore. They had given it as 50 lakh crore, which they are revising to 49.6 lakh crore, which is roughly 50 lakh crore. This year, it has been increased to 53 lakh crore. With special focus, they are looking at for capital expenditure being 12 lakh crore and effective capital expenditure being 17 lakh crore. Okay, that is a substantial value. 5 lakh crore is a substantial amount of money which is given as grant for capital asset creation, right? Then total resources transferred to states, including devolution, all that is given as a certain amount as well. But the key points are those numbers. So this is just the introductory part. Now we'll get into the actual budget itself. Okay. So we have the actuals of the previous year. We have the revision of the current year, this year. This year refers to which year? Tell me, 2025-26. Is that the current year or the past year? That is the current year, right? We are only in February now. And the budget was presented on 1st February. So when they presented, that is the current year. Last year, they had given it as an estimation. This year, that estimation is now more realistic in the sense they have gone through 7-8 months, 11 months you would say, but by the time when they started working on the budget, it would only have been 7 or 8 months. So they will only have data for 7 to 8 months. Based on that, they have made a revision for the same year. Actually, only 3 things need to be mentioned in a budget: confirmation of the previous year, revision of the current year, and estimation for the upcoming year. But if you write a revision, unless you write what was mentioned last year, the revision won't make sense. We'll have to open a new different budget document, check what is there. So for convenience, they had said they are also giving what we had given, what is the revision that is happening over here. Okay, so this is the revised estimate of the current year and the budget estimate for the upcoming year. okay, which will very soon become current year. As of April 1, that will become the current year, but that is an estimation or plan of action of what is to be done. So this is where we have the total receipts being, this is something that it would be a good data for you to not memorize per se, in the sense 53 lakh 47,315 you don't have to memorize, but roughly 53 lakh crore. Okay, because everything here is in crore. So this is 53 lakh means 53 lakh crore. If you can remember the size of the budget as say something like 50 lakh crore, and then remember, okay, with every passing year it increases by roughly around 3 lakh crore. Look at this, 47 roughly became 50, 50 has become 53. That is how it is showing a pattern. So if you can remember 50 or 53, whichever it is, whenever you are writing the mains exam, and this is relevant only for mains, this remembering this number, you can use it as a data to quote in your mains answers. I don't see the relevance of this in the prelims answer, that particular number itself. If you can remember the number 53 lakh crore rupees, that would come in handy. Okay, all right. So that is 53 lakh crore, and what I told you earlier, the total receipt being equal to total expenditure. Next line itself has total receipt and total expenditure, both of them being equal. There's one place here, one and one place there. Okay. So this is the equality between them. When a budget is presented, it has to be equal. We are only focusing on this part because this is all the past. This is the budget that's been presented this time around, of which 35 lakh 33,150 is in the form of revenue receipts, and 18 lakh 14,165 is in the form of capital receipts. This accounts for roughly about 74-75%. Roughly 75% of the revenue receipt of the total receipts come in the form of revenue receipts, and roughly about 25. I think this budget comes to 26%. So 74-26 is a split, which you can roughly remember as 75 and 25. Revenue receipt itself accounts for 75%, of which the tax alone accounts for 65%. Look at this, the tax revenue receipts itself of the 35 lakh crore, 28 lakh crore is in the form of tax revenue receipts. So tax revenue receipts accounts for 65% of the total receipts. Okay, we don't know where these kind of data can come in handy. It could be given as statements. Consider the following statements about the government's budget, and they might just simply give this as data. Tax revenue receipts typically accounts for somewhere around 60-65% of the total receipts. Could be a statement that they give, not something that we have seen, but you never know. But these are when we look at a data like this is the interpretation that we have to take, not simply sit and memorize the 53 lakh crore. That is more from a mains perspective where you can write. But from a prelims perspective, the interpretation from this is what we have to see. Plus, we also have to look at other things. Last year to this year, is there an increase? So are we generating more in the form of tax revenue or not? Similarly, with respect to this, is there an increase? Do you see an increase or a decrease there? There is a decrease. 6,67,000, 6,66,000. So non-tax revenue receipts is actually decreasing slightly. Okay, but this can result in questions like, over the last 5 years, the government's non-tax revenue receipts has continuously increased. These kind of statements can be framed out of it. So again, these are interpretations that you have to make. What should be there in your notes when you are making a note of the budget is not these numbers, it's the numbers. And ideally, when you prepare, you should have the trend for 5 years. 3 years is earlier budgets, and look at the previous 2 years as well. You will get to know what is the emerging trend. Okay, but if that's too much of effort, at least for 3 years, the only consideration that you should have is if there is a consistent increase or if there is a consistent decrease, then you look at what happened the previous 2 years. In these 3 years itself, if there is no consistency, it's easy. Make a note, no consistent change or inconsistent change. So whether it's 3 years or 5 years, inconsistent means what? 3 years it's inconsistent, 5 years also it will be inconsistent. Okay, if something is showing a consistent trend, then go back a little and see if there is an inconsistency prior to that. I just saw that. We aren't able to. Not audible in Manasarovar block. We can't. Yeah, Sarvin. இல்லையா அங்க இல்லைங்க. Just check பண்ணுங்களேன் கொஞ்சம். அங்க கால் பண்ணியாச்சா? Okay, Manasarovar block, is it okay now? And is the Zoom okay now? Are you guys able to read it? People online? Yeah. How about in the Manasarovar block? Are you guys able to hear? Can you confirm? Okay, va. Cherry. Okay. So in the that is from the revenue side. In the capital side, the recovery of loans and other receipts typically are disinvestment and disinvestment receipts. This is not a very important category because look at the contribution. In the overall contribution, it's very, very small. So it is not a very significant contribution, but we do see a significant jump over here. So this is 17,000. This is projected to be 47, but actual is 33. The projection is 80,000 crore through disinvestment means we are trying to. So in the projection till last year, we had NDCR, this non-debt capital receipt cumulatively contributing only 1% to total receipts. Now it has increased to 2%. And in the heading of NDCR, that is actually substantial. Even that 1 percentage point increase is something that's substantial. That means the government is possibly looking at disinvesting some of its assets to make money, to generate money. Wherever they feel there isn't a need to hold on to an asset, they are probably looking at it. Okay, maybe loss-making PSEs, they are looking at disinvesting, or maybe profit-making PSEs, they are looking to sell a small portion of it, like share sale or something to generate money. One of those is what is likely to happen. But this is the key point for us. 15 lakh 74,000, 15 lakh 58,000. We are already seeing a decrease in the borrowings of the government. 16 lakh 95,000. So we are seeing an increase over here in terms of how much they are intending to borrow. Good or bad? First things first, just borrowing more is not necessarily a bad thing. That is why whenever we come across fiscal deficit, hardly ever we come across fiscal deficit as amount of money. Almost certainly we come across fiscal deficit as a percentage of GDP. The reason is it depends on our repayment capability. Whether a certain borrowing is acceptable or not, it depends entirely on the repayment capability of the country itself, right? So if our borrowing is increasing, but our GDP is increasing by an even greater extent, is increased borrowing bad then? No. As a percentage of GDP, our borrowing might actually come down. And you will see that is what is the case, because this year, the fiscal deficit is 4.4% of GDP is what they have said. By the end of this year, we'll attain a fiscal deficit of 4.4% of GDP. The next year's target is to reduce it to 4.3% of GDP. That is the target. And to achieve that target, we can afford to borrow this much. We can increase borrowing and still attain a target of 4.3% of GDP as fiscal deficit, which means reduced fiscal deficit, because we are believing that our GDP will rise by sufficient extent for this increased borrowing to only account for 4.3% of GDP, which means increased borrowing is not bad. Of course, it has to be used for productive purposes, like you said, but even if we are using it for productive purposes, we cannot borrow any amount of money. There has to be limitations in place. That is what is the role of FRBM Act, Fiscal Responsibility and Budget Management Act. Although the act is not currently very active, if you want to call it, but that act is always there, and the documents that the act mandates are still given. Okay, and the government is at least setting itself clear-cut, transparent targets to meet. That is part of its fiscal responsibility and budget management. So we cannot borrow endlessly. We can increase our borrowings as long as a percentage of GDP, it remains within limits. Okay. So the increased borrowing is not a cause of concern. However, how to deal with this information in the prelims examination? Two types of questions could come in. If the question simply says fiscal deficit has consistently declined over the last 5 years. Wrong, because fiscal deficit has declined here, and here itself we see it is projected to increase. But fiscal deficit as a percentage of GDP has consistently declined over the last 5 years. Correct. Since COVID, we have consistently reduced the fiscal deficit as a percentage of GDP. So in the question, we have to very clearly look at whether they are giving the term as fiscal deficit or fiscal deficit as a percentage of GDP. The answer will vary whether the drop has been consistent or not. Fiscal deficit refers to the amount of money. Fiscal deficit as a percentage of GDP refers to the in percentages. Okay, I'll take a pause. If you have something to ask, let me or ask me. I'm doing this session with the assumption that you are already familiar with the basics of public finance. Is that a fair assumption to make? Because if you are not, then the speed at which I'm going might seem too fast. By the time your mind is processing what is fiscal deficit, I've already finished talking about fiscal deficit. Should I slow down? Yes, sir. Okay. See, I'll give you a better alternative because I don't know what pace to go at. Different kinds of people are there. I don't mind if you simply say, can you just quickly revise that concept of what is fiscal deficit? Something like that. Okay, just raise your hand. Get over your embarrassment of asking this question in front of everyone. I can do a quick revision without spending too much time, but you have to take the initiative if you want to get the benefit of that. Ask me to revise some small concept, I will do that. Okay, in whatever is the quickest way possible, I'm open to doing that. Let me know, okay? Huh? Do it now, like particular topic you have to tell me. Huh? Annanagar weekend batch, I finished 2 days ago, missed class. Okay. All right. Just a quick recap of fiscal deficit. With fiscal deficit, I had actually done the introduction without being necessary. Okay, so based on the information that we saw, I'll take simpler numbers to explain fiscal deficit as a concept. Let's say the government has committed to an expenditure of rupees 100 in a year. Okay, they have said in a particular year they are going to spend 100 rupees. They have made a commitment. They have presented the budget saying we are going to spend this much amount of money. That includes revenue expenditure, capital expenditure, both of them. Cumulatively 100 rupees they are going to spend. Now the question is, do they have total receipts equal to that? So then comes the first question. What do we mean by total receipts? So the main source of the government's receipts is tax. So tax revenue receipt is their major source. Okay, that is what I said earlier, accounts for 65% of the government's total receipts. 65% is in that form. Then comes a concept called as revenue receipts itself, government's own money. Revenue receipts means government's own money, but revenue receipts received in the form which is not tax. There are so many different forms in which the government receives, like interest receipts, fees, fine, grants received, profits from PSEs, RBI's profit share, all of this. These are not taxes, but these are earnings of the government. It belongs to the government itself. Okay, so these are, because we don't have one name for this, we refer to it as receipts other than in the form of tax. So non-tax revenue receipts. This accounts typically for somewhere around 10% of the total receipts. So that is 75%, or in this case 75 rupees. Out of the 100 rupees required for expenditure, 75 rupees comes in the form of tax and other income that the government gets. Now the question is, where does the government get the remaining 25 rupees from? They have to get it from somewhere, right? Where do they get it from? They do borrow, but they also look at, is there anything, borrowing is a liability, right? Borrowing means a burden on them, they have to repay it, they have to pay interest, all of those concerns are there. So the government is looking, is there any way we can get money without resorting to borrowing? That is where typically from our household, we might have put some FD somewhere and we might withdraw that. We were getting interest on it, but we are saying, no, that's okay, I withdraw that money. Or I had a land, or I have a land, I decide to sell it. I have gold, I decide to sell it. By losing some asset that we have, we can get money. Okay, that is what is a capital receipt, by losing an asset, but without creating liability. Non-debt capital receipt. From the government's perspective, either they can recover a loan that they have given in the past to state governments or other countries, but that is not going to be a major source. Look at the number, it is only about 3,000 crore as I showed you. Okay, if at all anything comes over here, it is mostly by selling its gold or Navaratnas. The CPSEs, you are aware of that, right? They are called by different names, Navaratna, Maharatna and all those things. So by selling the company or a portion of the company, that is what is most valuable to them. That is why they are even categorizing it by that name. They are so crucial to the government. So they are saying if there is one particular PSC which is not profit making, which the government need not be involved in, they can sell it off. Or if it is profit making also, instead of selling it off entirely, take 10% of the company and sell it. That will generate some money, because if it's profit making, people will be willing to buy shares of that particular company. So in that form, get money. That is non-debt capital receipt. This is a very, very meager contribution for the government's resources. Last year, this was only around 1%. The year before that, around 1%. This year, we are targeting a 2% non-debt capital receipt. Whether it will happen or not, only time will tell. Next year is when we will get to know. Maybe it won't happen. Okay, as you saw when I scroll down, you will see last year we had a target of around I think 5,000, but we got somewhere around 3,000 only. I'll show the number, then we'll see. So this is 2% means what? 75 plus 2, 77 rupees is all that we are getting. Okay, even then we still need 23 more rupees. No other choice but to borrow. This borrowing is what is called as debt capital receipt. That's why it is defined as the difference between total expenditure and total receipts excluding DCR, debt capital receipts, or it is the reflective of total borrowing requirement of the government. Okay, all right. So 23 rupees is something that the government would have to resort to borrowing over here. Coming back to the numbers that we were just discussing. So the target was other receipts. Other receipts is disinvestment. In the past, they used to mention it as disinvestment itself. Now they are not referring to it as disinvestment, it is other receipts, but in a detailed document you will go and see it is mentioned as disinvestment over there. So that is what it is, recovery of loans and disinvestment. The target was 47,000, I said 4,000, it's 47,000, this is 33,837 crore. Now the target is 80,000. If we successfully manage to sell all the assets that we intend to sell, we may get that. But there is a very good possibility based on past trends that we might get only around, if we are reasonably lucky, or if the government is successful in selling off, we might get 50 or 60,000 crore max. Even that might be a bit of a stretch for the government. They may not be able to, or maybe they will be, because they are, maybe without that confidence they won't suggest this number. Okay, so maybe they will be able to, they have something in their mind, which means that over the course of this year, keep looking out for government disinvesting something. Think, see if any company is being disinvested. If it is there, then you will have to go into questions of, is this disinvestment strategic disinvestment or not? What is meant by strategic disinvestment? Don't guess. Okay, when more than 50% of the of the shares of a company is sold, which means it turns from a public sector company to a private company. The management becomes private. Then we'll call it a strategic disinvestment. It's another name for privatization. A company becomes private, that is strategic disinvestment. What have they changed? More than 25 strategic. Sorry? Less than 50? Provided no single private party owns more than 50%. Whoever owns majority, they'll be. So that is also true. It is not just now. In the past also it's been there. If multiple entities have ownership, to give a common example, you look at a company like Tata, you know the Tata group of companies, right? When we ask who owns the company, we think Tata owns the company, but Tata itself on its own doesn't have more than 50% ownership in that. It is owned by so many different small entities that all that matters is who's the single largest owner, and their brand name and all those, but they themselves cannot influence any major decision. It has to happen through a board meeting. So in a scenario like that, where the government owns less than 50, but government is the single largest shareholder, that will continue to be under government management. Okay, that could also be there. But if the stake sale, in a generalized manner, if the stake sale is greater than 50%, the government, we assume, loses the management control, and so it becomes strategic disinvestment, okay, or privatization. Okay. So total receipts, total expenditure accounted for. Now when the total expenditure, how are they splitting it apart in the document? Total expenditure is split into on revenue account, on capital account, 10 and 13. They have given the formula itself as 10 plus 13. Total expenditure on revenue account, total expenditure on capital account. Okay. Total expenditure on revenue account is 41 lakh 25,494 crore. 41 lakh crore out of 53 lakh crore. Okay, which accounts for maybe somewhere around 80% of the total expenditure. If it's 100 and it's 40, 80, that 80%, roughly around 80%. So what we have to also infer from this is revenue receipt accounts for 75% of the total receipts. Revenue expenditure accounts for roughly 80% of the total expenditure. Which means what? The revenue receipt is not enough to meet the revenue expenditure. It is going to definitely result in what is called as a revenue deficit, as we will see. Okay, right here at the bottom we have revenue deficit. So it is just indicative of that. The capital account, which means capital expenditure, is only 12 lakh crore, which is somewhere around less than 24%, somewhere around, let's say 22 or 22 odd percentage. So this means it will be around 78. This will be 78, this will be 22%. Okay, roughly around that percentage, or maybe 20%. I'm not giving exact numbers, roughly. What was the DCR? What percentage of DCR, debt capital receipt? 23 is what we wrote a number, roughly around 24%, 23 to 24%. So our capital receipt, within the capital receipt, the borrowing alone accounts for 24% of 23 to 24% of the total receipts. But the expenditure on capital account as a whole accounts for only around 20, 21, 22%. Which means what? All of the borrowed money is not even being used for capital expenditure purposes, which means we are violating what? The golden rule of borrowing. What is the golden rule of borrowing? Borrowing should only be used for investment purposes. The DCR should only be used for capital expenditure, which effectively means there should be no revenue deficit. But clearly we have a revenue deficit, which means that we are using some of the borrowed money to meet the revenue deficit, to take care of the day-to-day expenses of the government. Good. So these are observations. Now the next observation is why are these two terms added? Where we say revenue account, of which two things: interest payments, grants and aid for creation of capital assets. Because we are going to use this information for two other things. One is effective capital expenditure, where we will say this is a part of grants. Number 12, grants and aid of capital, grants and aid for creation of capital assets is a part of revenue account. But it is a part of the revenue account which is acting like a capital expenditure because it is used for creating assets. Okay, so center gives a grant and aid. Okay, center gives a grant, let's say to the state government. They give a grant to the state government and says to the state government, you can use it in any way you want. And the state chooses to use it for creating asset. Will that be included here? It will not be included, because that is the state's decision of how they are using it. Why are they including it as part of effective capital expenditure in the center's budget is not because one particular state has decided to use it for capital expenditure. This grant itself was given with the condition that it must be used for asset creation. Who put the condition? The center. So as a result of whose insistence is that asset getting created? Center's insistence. Okay, center has compelled the state to use this money for creating asset. So center is saying effectively we are the cause of our creating that asset. We cannot claim that asset because it's in state's name, but we are the reason for creating that asset. So we would like to take that into our name. But logically we cannot do that, or theoretically we cannot do that because it's a revenue expenditure. So we create a new heading called as effective capital expenditure, where we say the explicit capital expenditure. To that we add the grants which were given with the intention of, or with the compulsion of, creating capital assets. If they have not used it for the stated purpose, the center can even withhold future payments as a punishment, which means the center is almost certain that they will use it for, the state will use it for asset creation. Okay, so these two together, 12 plus 13 is what is called as effective capital expenditure. That comes to 17 lakh crore. How much was the DCR? Debt capital receipt. No, not percentage, amount. 16 lakh crore, somewhere around 16 lakh crore. So 16 lakh crore borrowing, effective capital expenditure 17 lakh crore, which means all of the borrowed money is used for A capital expenditure only. If you include the effective part of it, then the government is not misusing any part of its borrowing. The government is ensuring that all of the borrowing is used for capital expenditure and more than the borrowing, which means some part of the revenue receipt might also be, some part of the NDCR is also part of, that is used for creating asset, which is a very positive sign. If you are able to create asset, only asset with our borrowed money, and we are able to create asset even without borrowing money, what better position can the budget be in? That is what they are trying to convey through the effective capital expenditure. Okay, these are all interpretations. So what is the feeling that we get? Is the budget in good health or not? It looks like they are in good health. Okay, of course there is a lot more to be done, but it is not in dire straits. We are not in a desperate situation where we are not even able to take care of our day-to-day expenses. We are able to very much take care of our day-to-day expenses and spare some money to spend towards capital expenditure purposes, is what is the interpretation that we can make out of this. Okay, just to show that again, that our DCR is roughly around 17 lakh crore, 16 lakh 95,000. This is 17 lakh 1,000. Very close, almost equal, but this is slightly greater. The expenditure is greater, which is actually a very good sign. Okay, I've explained 12. Now I'll also explain 11. Okay, why is interest payment segregated? But why is the formula of primary deficit fiscal deficit minus interest payments? So we have a concept like primary deficit, 17 minus 11, 17 is fiscal deficit, 11 is interest payments. That's a formula. But why? Why is the formula? Why do we need a concept like primary deficit? What if the government doesn't have to pay any interest? But why single out interest? I'll come to it. But why do you need to know that? Not the previous government. What if the same government has been in power forever? I mean, forever means for 15 years. What you said first is correct. I'll just wait for some other answers before I come to that. Okay, it is not because interest payments are useless payments. Interest payments are actually productive payments. Are they? Can we say interest payments are income? Are part of national income? What is the formula for? Have I told you anything about 4 types of income? Rent, wage, interest, profit. Interest is a type of income. Money lending is an economic activity. Interest is an income, just like providing labor, providing land, providing money, capital. So these are all economic activities and income received for that. So it's very much part of income. So it's practically like a government employee is working, salary is given to them, someone is giving loan, interest is paid to them. It's income. Why single out that? The only reason for that is the size of how much we have. Okay, and which segment of the population is getting this money. Now, if salary is paid, this year there is economic activity happening, governance is happening, so salary is paid. Okay, pension is not productive at all, or grants are not productive at all, but at least it is going and reaching the most vulnerable. People who are otherwise not able to earn income, people who would otherwise not be able to survive, it is helping them. So it is helping the country, stabilizing the country, helping the people of the country. Loans are given by people who are already well off. Financial institutions, they are already well off, they already have money, they are the ones who are giving the loan, so more income is given to them. Okay, fine, they are at least giving money and that is how the country is growing, so pay interest to them, no problem. But look at the extent of it. 14 lakh crore out of 53 lakh crore, which is roughly around 25%, roughly around 25%. Okay, so of the total money spent by the government in a year, roughly 20 to 25% they are paying just on interest payments, not even repayment of principal. Not even repayment of principal, only on interest payment they are paying that much amount of money. If they look at all the other revenue components, expenditure components, salary might come, but at least for salary there is some work happening over here. But with respect to interest, a loan given in the past year, we are just holding on to that loan. We use that loan for some purpose, we are not able to repay the principal, so we are having to pay interest. As long as the loan is in our hand, we need to keep paying interest. But the actual effectiveness of that, effectiveness of the borrowed money happened when it was used for some construction. Let's say a road had to be built, money is borrowed, road is now built. We are enjoying the benefits of road, all right. But the loan that we have taken, since we have not repaid, we need to continuously keep paying interest. So it is an income, but it is different from the income in the form of salary. Because when you say salary, this year you are working for which you will be paid. Next year you are working for which you will be paid. So there is some work happening that year. In this case, the only work that is happening is I'm holding on to the money. Because I'm holding on to the money, I'm having to pay interest. And because it's a huge component, we are singling it out and saying, if we did not have this, what would our deficit have been? Of course, other points also are relevant because the borrowing is of past. So past borrowings, what is the implication of that on the current position? All of those are also significant factors that play a role in deciding that as the subtraction factor when it comes to primary deficit. Okay. If the interest payments was very small in India, past borrowings were very low, we would probably not even introduce a concept called as primary deficit. Okay, or we might take some other inefficient expenditure and try to find out if that is a significant factor. We could come up with a new concept, but here it is because of the extent of the payment of interest that is happening. Okay, that is why within the revenue expenditure component, these two are singled out because each one conveys a separate meaning. So for ease of calculation, we single that out in the description here itself. And then we of course have the other related formula, effective capital expenditure we have seen. Effective capital expenditure we have seen. Revenue deficit is nothing but 10 minus 1, which is revenue expenditure minus revenue receipt. Effective revenue deficit is revenue deficit minus grants for asset creation. Fiscal deficit is whatever we said earlier, 9 is total expenditure and 1 plus 5 plus 6. 1 is revenue receipt, 5 and 6 are recovery of loans and other receipts that were given. Other than DCR, whatever is there, that is there. And primary deficit is 17, fiscal deficit minus 11 was interest payments. So this is the formula, but here alone you will find along with the numbers below it, you will also find in bracket percentage of GDP, because the absolute number is not of great significance. We can't make any sense out of it. Is it good, bad? Is the performance good, bad? If you simply look at it, fiscal deficit, you will look at it and say, oh, fiscal deficit is increasing, it is bad. But if you look at it, it says even in spite of that borrowing as a percentage of GDP, we are able to bring down the fiscal deficit, which means we are being more efficient with respect to our money. We are managing our budget better. We are being fiscally more responsible. Okay. Now we have a pie chart here which explains where do the receipts come from. Okay. I told you how much is in the form of tax revenue receipts, 65%, tax alone, non-tax included 75. So corporation tax 18%, income tax 21%. There is a star over here because below they have written, see, income tax means what? Tax on income. Okay, tax on income, not tax on transaction. Tax on transaction is called as what? Goods and services tax. Transaction of goods and services. But there is one tax called as securities transaction tax, which is a significant, not very significant, but which is a noticeable tax that the government is collecting, which is like GST in the sense it is on the value of transaction that they collect. Securities here refers to bonds and shares and all those. So every time you buy or sell bonds, based equal to the value of the bonds, you have to pay a tax. Very similar to GST, right? Every time you buy a pen, you have to pay a GST on top of it. But every time you buy a bond, you have to pay a tax. That is not a GST. Okay. What type of tax is GST? Direct or indirect? It's an indirect tax. The government collects it from the shopkeeper, you have to pay it to the shopkeeper. Hence, it becomes an indirect tax. But securities transaction tax, I buy the commodity, the government comes and collects the tax directly from me on the value of my transaction. So direct tax or indirect tax? It becomes a direct tax. It's a taxation on transaction, but it's a direct tax. And it is not a corporate tax, right? So they have included that also in income tax. To highlight that, they have put a star over here. It is given income tax includes securities transaction tax. That's all. But that's a very, very negligible component. You can simply look at it as income tax. The star is there, so I explained, that's all. So this is 18%, this is 21%, 18 plus 21, 39% comes in the form of the main direct taxes that we have, corporate tax and income tax. Then you have GST, which accounts GST and other similar taxes to that, smaller taxes, 15%. Union excise duty. What is union excise duty collected on still? GST is what replaced union excise duty, no? Along with many other taxes. Why have they mentioned union excise still? On liquor, there is no union excise duty. On liquor, there is state excise. Only on petrol. Not only on petrol. On petrol, it's there. On tobacco and related products, it's there. You're aware of that, right? Tobacco is part of both GST as well as there is a union excise on top of it. Both are there on tobacco. So, mainly petroleum products, the 5 fuel products that are there plus tobacco. These are the main. Alcohol is a state subject. It won't come in here at all. Alcohol tax is all alcohol for human consumption. It's entirely inside the state. So, that won't come here. These components alone, which is fuel and tobacco alone, constitute for 6% of the tax of the total receipts, which is even more than the total customs duty that we collect. Just on fuel and tobacco alone contributes to 6% of the total receipts, which is greater than the customs duty. And customs duty is 4. So these are all indirect taxes. So that is another 6 plus 4, 10. So this becomes 25. 39 in the form of direct tax, 25 in the form of indirect tax. Cumulatively, 40 plus 24, 64%. 65 I said earlier, 64% is what it is. Okay. This is the share of tax. This entire thing is the share of tax in the overall total receipts. Major part, 2/3 of the total receipts is contributed by tax itself. Okay. But another observation that we have over here is the split between direct tax and indirect tax. Which is the which is the fairer tax? Direct tax or indirect tax? More than direct tax, we should say it is, you can say direct tax. The one who's spending is the one who's paying. But more than that, income tax is the fairer tax. Taxation on income is a fair tax because you can say proportionally I can collect tax. Whoever earns more, we can collect more amount of tax from them, or progressively also we can collect tax. As your income increases, a higher share of your income will be taken away as tax, because the government's logic is as income increases, income inequality also widens. Says who? As income increases in a country, income inequality also initially increases. Says who? Kuznets-Kerr. Okay, says that inverted U shape. So the inequality rises as income rises, but this inequality has to be brought down. If you leave it on its own, automatically it will happen, is what one belief is, but it might take 200, 300, 400 years for that to happen. During that period, the people at low income will suffer. So the government says, how can we accelerate this process? Through income redistribution, by collecting more tax from the rich and spending it towards the poor through finance commission and all those things. So proportional and progressive tax helps in this process. Okay, so direct tax is the only one where you can actually implement proportional and progressive tax. We know that if a tax is collected on the value of transaction, typically like GST, union excise, customs, in effect these taxes tend to be regressive in nature, because both rich and poor, while buying the same product, end up paying the same amount of tax irrespective of their income. So a lower income person pays a greater proportion of their income as GST, which harms them. Okay. Government being aware of it is the reason why they have these slabs of taxation, 5%, 18%, slab itself is there. Luxury items in 40%, very, very essential items, no tax at all. They could collect tax from the rich, but at the point of purchase, they are not able to distinguish between rich and poor. So they say if it's an essential item, no tax for anyone. Okay. So the reality remains that even if all these discounts are given, 5% means it is still regressive, because rich pays 5% of transaction, poor pays 5% of transaction. The rich and poor end up paying the same amount of money as tax, which is regressive in nature as a proportion of their income. So ideally in a country, we should keep indirect tax collection to a minimum. Okay. Indirect tax or GST, these sources of tax should not be the major contributor to taxes. We should ideally be collecting more tax in the form of taxes on income. Okay, that is the logic. And a few years back, this was actually very close to each other. In the sense, if the total collection was 65, it will be something like 33, 32. That is how it used to be. Direct tax being 33, indirect being 32. A couple of years it has even gone the other way around, where indirect tax has contributed more than direct tax, which is not ideal. But over the last 3-4 years, we are seeing a clear trend where the taxes collected in the form of income tax is now contributing much more, which means that maybe we are moving towards a much fairer taxation system, which is again something that we interpret from this data that we have over here, 39% and 25% split. Okay, which we are going to see again when we look at tax to GDP ratio, where you have a table that they have given bar charts with the split between direct and indirect tax, but that as a percentage of GDP. So this is the main sources of money with taxes. And now we go to non-tax revenue receipts, all the interest receipts, fees, fines, grants received, profits from PSUs, all those account for 10% of the total receipts. Non-debt capital receipts contributing 2%, expectation, this is expectation, and borrowings and liabilities 24%. Here I had said 65, so this came to 23. This is actually 64. Sorry, yeah, 64. So this is 24%. That's the actual. This is the actual split. I'll take a moment. If you have any questions, please ask. Custom, sir? All of those are indirect taxes. This union excise, customs, GST and other, all of those are indirect taxes. What differentiates a direct and indirect tax? If the government imposes the tax on one person and they have to pay it out of their own pocket without legally being allowed to shift the burden to someone else, which means they have to pay the tax the government collects from, direct tax. If one entity pays tax to the government, but legally they have the permission to collect it from another person by writing on a bill saying, I have paid tax to the government, so I am collecting it from you. So the burden of taxation, if they are able to shift, it is indirect tax. Okay. Okay, so coming to expenditures now. Expenditures goes on a completely different tangent to how we have seen in the tables and all those, with it being broken apart into state's share of taxes. It's a big component that is given over here, but this component was missing in the first table that we had, which is what is given here in highlight. If you read what is given here, total expenditure is inclusive of state's share of taxes and duties here, which have been netted against receipts in the table on page 1. In the previous table that we saw, they have already adjusted for that before representing that. Okay, here they have shown that as a separate value. So state share of taxes is 22%. What do we mean by state share of taxes? IGST, the state share is also collected by the center, which will subsequently be given to them. Okay, don't include finance commission because finance commission and other transfers is separately recorded here. Okay, so that part is not what is mentioned here. This is by default what is rightfully the state's. Some taxes which the center collects on behalf of the state, but it will eventually be given back to the state, like IGST. That is the best example for that. Okay, when they collect IGST, one part of it belongs to them. The remaining part is what is the half which they are supposed to give to the state. That is what state's share of taxes. Finance commission and other grants, centrally sponsored scheme. What is the difference between centrally sponsored scheme and central sector scheme? Centrally sponsored means? It is centrally sponsored scheme means it's a scheme where the funding is distributed between, the funding is shared between the center and the states. So center contributes some amount, typically 60%, state puts 40%. In some states it could be 90-10 also, special category states where 90% center gives, 10% the state has to put in. Okay, that is centrally sponsored scheme. Central sector scheme means 100% it's a government scheme. 100% the government, central government will put the money for central sector schemes. Okay, can be sometimes confusing. This is that, that is this. So that's why I just mentioned it. Interest payment accounts for 20%. The number drops to 20 because this is included. If you remove this, this number will rise to 23 or 24%. Okay. Defense expenditure 11%, major subsidy 6%, civil pension 2%, other expenditures doesn't give us a lot of information, or at least not as much information as receipts did. But a couple of points to notice: how much does defense contribute? Ideally, they could have added education and healthcare and all those here. That would have given us more information. But there is a different part of this document itself which conveys all that information. Okay, we will get to that. This is a summary of all the deficits once again, so I'm not going to discuss this further. It's just that part taken separately and given over here. This is the source of borrowing. Where are they borrowing from? What are the types of borrowing? Market borrowing, which refers to the long-term borrowings of the government, more than 1 year. That is what accounts for fiscal deficit. Short-term borrowing, T-bills. T-bills, they know that they will be able to repay the entire amount within a year itself. So it is most of times not recorded in the budget. Sometimes you will find this carry forward, borrowed in 1 year, repaid next year. Okay, or borrowed previous year, repaid now. That is why you might find this minus or a plus value over here. Securities against small savings means borrowing from the public account of India. So the consolidated fund needs money, they borrow from, say, post office funds or pension funds and all those things. So that state provident funds is given over here. Okay. Key point of observation: external debt accounts for only 15,385 out of 16,63,066. Out of that, only 15,000, which is how many percentage? Less than, lot less than 10. Okay, which is less than 10%, which means 90% or more of the government's borrowing is happening from internal sources within India. Which means what kind of crisis are we likely to avoid? A sovereign debt crisis, not BOP. BOP is about trade. If there is a trade imbalance and we don't have enough, a sovereign debt crisis where we have borrowed from a foreign entity and we are unable to pay, they will come and influence what decisions we should be taking. Any example of a country which? Sri Lanka, Pakistan. In the recent, currently, what about India? Has India ever been in a crisis like that? 1991, where we had a balance of payments crisis, but the government had to step in and help because it was the government's policies which eventually led to that crisis. So the government had to borrow from IMF. IMF said, we have some conditions for you. Our sovereignty comes into question. So it becomes a sovereign debt crisis, right? So that is the last time, and we resolved that we should never be in a situation like that again. We have a few safeguards against it. One, our borrowing is much lesser. Second, our forex reserves are substantial. There is going to be a later document that we are going to see where we are going to create a link between this external debt, not just, this is only government's external debt. We are going to take into account all of India's external debt, private borrowing, external commercial borrowing, all of it, and we'll find that we have forex reserves which accounts for almost 80% of our debt, which means we are not going to be any kind of immediate sovereign debt crisis. We have enough forex reserves to deal with all of these issues. So we are at the moment at least not likely to, or the foreseeable future, we are not likely to be in a crisis that Sri Lanka has undergone, is undergoing, or Pakistan is undergoing, or a few other countries across the world, they are in crises of this nature. We are likely to avoid that. And it's a conscious decision on the part of the government to reduce the external dependence for borrowing. So this is a graph which shows how the deficit has changed over the years, but fiscal deficit not in absolute value as a percentage of GDP. This is where I said over the last 5 years, 1, 2, 3, 4, 5. From 2021, fiscal deficit as a percentage of GDP has consistently fallen. 9.2, 6.7, 6.5, 5.5, 4.8, 4.4. This is only projection. 4.3 is only projection. This 4.4 as of March is going to be a fact. Okay. Which means that over the last 1, 2, 3, 4, 5, 6, over the last 6 years, fiscal deficit as a percentage of GDP has consistently fallen. Okay, that's an observation that we make out of it. But that is true with respect to revenue deficit, that is true with respect to primary deficit, and with respect to effective revenue deficit, all of them. So from a graph like this, your interpretation is consistent decline in all of these as a percentage of GDP, not in absolute terms. You know, in absolute terms, this 4.3 is of a greater value than even this 4.4. We just saw that. This is 15 lakh crore, this is 16 lakh crore. Okay, so that is another observation that we make here. This is new. This I had never seen. I don't think last year's document had this. Trends in debt. What debt are we talking about? Yeah. This has not happened yet. Yeah. Then it's not a consistent decline. Good point. This is 1.5, but I was only talking about 6 years till this point because this has not yet happened. Okay. We are saying 4.3. No. What if it is 4.4 next year in reality? We are not able to reduce it to. So that we cannot comment on yet. What we can definitely comment is this. But even this 1.5 and 4.4 has not yet happened. So they have projected based on data till about November or December what is likely to happen by March. So we'll only get to know next year whether this has even happened. This is also a revised estimate only. But it's more likely to happen than this. This we'll have to wait and see whether it happens or not. We don't know what emergencies will come. Maybe if it reduces to 1.4, can happen. It can go below projection. But as per projection, this is not going to reduce next year, which means if this actually happens with revenue deficit, we cannot claim a consistent reduction. We cannot say it has consistently declined because there is 1 year where it has not declined. That's a good observation on your part. Okay. All right. So this is a data that is fairly new. I think this is, they have added this only now in this budget at a glance document, which is a debt. But debt, whose debt are they talking about? Based on number, can you guess? Center's debt. This is Center's debt alone. You guys remember FRBM target? That is the current target. Original FRBM. That is not FRBM target. That is the government set target. FRBM max target is how much? That is fiscal deficit. I'm asking about debt target. Less than, not 40. Exactly 40. 40. Exactly 40. Correct. The center should have a public debt of 40% of GDP, and they did not give a target for the state. How can the target for state be given to the center? Okay. So the target given was the general government debt should be 60, with the state center's government debt being 40% of GDP. Had to be achieved by when? By 2025. 2017-18 we had brought it to. Okay, we had brought it down to 48.9% with the expectation that 1, 2, 3, 4, 5, 6, 7. In 7 years, we were probably on track to reducing it to 40% or 41, 42, somewhere on that lines. We were on track to get somewhere close to 40%. COVID happened. The general government debt target was 60. Center's debt alone rose to 60 during the COVID period, which means the general government debt went up to 85%. We had managed and kept it somewhere around 75%, 68% or so general government debt, 68 to 70%, which shot up to about 80-85%. They have not given general, they have only given centers here. Centers alone rose to 61, which means practically by 2025 meeting the target of 40 is not possible. So we are not going to meet the FR. We have already violated, as of 2025, we have violated the central government debt target of FRBM. Now what the government did last year is they have given a projection for 2031 where they say by 2031 their intention is to gradually reduce the central government debt and bring it down to 50 plus or minus 1% of GDP. What is the fiscal deficit target? What is the fiscal deficit target? No target. FRBM is there. FRBM 3%, no doubt. But by when? By 2020-21. That is long gone. So that target we are not in a position to meet. So right now, the government has given itself a commitment, and the commitment is only with respect to central government debt, not with respect to general government debt, not with respect to fiscal deficit. What they have told is, we will keep fiscal deficit at that level where we are on a declining path of public debt, central government debt, to reach central government debt level of 50 plus or minus 1% by 2031. That is all that they have said, which means they are expecting that every year fiscal deficit will reduce. By what margin, we don't know. We don't have targets for fiscal deficit at all now. We only have target for central government debt to reduce it to 50% of GDP plus or minus 1. Okay, by 2031. Why 2031? End of what? Correct. The current finance commission cycle ends in 2031. By then, so to align with that, that is what they have kept themselves a target of. Okay. There are different definitions of debt in FRBM and in the government statements of liabilities. That way we have two things. Debt as defined in FRBM Act includes external debt valued at current exchange rate and liabilities on account of extra budgetary resources. That is the extra difference. That is why the difference comes in. Okay, but when we are looking at it, we have to look at it from the FRBM perspective. FRBM debt is a slightly greater debt than how the government defines it. So it is that debt that they have a target of reducing to 50. So that is what the red line is, what we have to follow. That is debt as defined by FRBM. Okay. Within the limit, either. This is not ideal versus real. How debt is defined itself is different in the government's account and in FRBM's calculation. Both are actual debt of the government. One is by the government's own definition, one is the FRBM's definition. What they have said is, the debt as defined in FRBM includes external debt. In what way is it valued? Okay, plus it includes liability on account of extra budgetary resources. Off budget borrowing, you have heard, no? So off budget borrowing, the government does not include in its budget. But the FRBM says that also should be included in your debt because that is a liability on your part. So that burden is slightly greater than how the government defines it. Both are actual values of the government. It doesn't mean we are within limit. Both are real values. This plus this gap is the FRBM debt. Okay. Now this is a much detailed explanation of the receipts and expenses, corporate tax, taxes on income, all those things, which I am going to skip through, because we have seen this already in detail. This is the other thing. Okay, again, you look at a graph like this. Observation is trends, what is happening. Okay, can we say this is tax as a percentage of GDP? Can we say India's tax to GDP has increased over the last decade? Has India's tax to GDP increased over the last decade? 11.2, 11.2. It does not. Or even if it is 11.4, this is not substantial enough to call it as an increase. Okay. If it was 11.2, this is something like 13 point or 14 point, then you can say there is an increase. Okay. Otherwise, you can't say. Has it consistently increased? Consistently decreased? Nothing. So observation here is there is no consistent pattern with respect to this. It is remaining largely the same, more or less the same. Tax to GDP ratio. As we are increasing our GDP, we are continuing to collect similar levels of tax, which can be interpreted and connected with which concept of ours? What did you say? Tax buoyancy. Exactly. Which is a measurement of rate of growth of tax revenue as a proportion of rate of growth of GDP. Now GDP is growing, everything is given as a percentage of GDP. GDP is growing by a certain extent. If the tax revenue was growing by greater than that, then this percentage would definitely have increased, right? There is actually buoyancy, you will notice. From 10.8 it is growing to 11.5. It is very, very buoyant. But subsequently, it has remained more or less idle. So Indian taxation is not very highly buoyant. We are continuing to collect at the same levels. As income is increasing, in proportion to that, the tax revenue is also increasing. It is not increasing more than proportionately. Okay, that is the conclusion that we can make. The concept of tax to GDP ratio itself is linked with tax buoyancy concept. What is, you know the formula for tax buoyancy, right? Should I write it? Tax buoyancy. If you want it in the simple to remember form, you can simply write it as tax revenue divided by GDP. But in a true sense, this is not the formula. The true sense, the formula is rate of change of tax revenue divided by rate of change of GDP. So you'll have to write it as current tax revenue minus previous tax revenue divided by previous tax revenue divided by current GDP minus previous GDP by previous GDP, both into 100. You have to do all of those things. But simpler way is tax revenue to GDP. What is tax elasticity? Not relevant here, but as associated concept. Same, tax revenue divided by tax rate. If there is an increase in tax rate, by what extent is it increasing the tax revenue? Once again, the formula is rate of change of tax revenue to rate of change of tax rate. That's how it is to be written. Anyway, here what is relevant is buoyancy. So this is how the overall receipts of the center has increased without borrowing, I believe. Nothing. One sharp increase in net tax to center is what we are seeing. And what do we mean? This is interesting. What do we mean by total non-debt receipts? What is total non-debt receipts? Do you realize that that is not NDCR? This non-debt receipt is not NDCR, non-debt capital. It says non-debt receipt, not non-debt capital receipt. Any receipt which is not in the form of debt, which means TE minus DCR, sorry, TR minus DCR. Total receipt minus, it is an inclusion of NDCR plus tax, non-tax revenue plus net tax to the center. Sum of that. That's why it is right on top. Okay, it is sum of all the money that the government is getting, which is not in the form of borrowing. Non-debt receipt, that's all. It doesn't say non-debt revenue receipt, it doesn't say non-debt capital receipt, simply says non-debt receipts. Okay, so you can also write the formula for fiscal deficit as total expenditure minus non-debt receipts. This is nothing but RR plus NDCR. You can write it this way also. This is right at the top, right? Red line. So it's a sum of all of these. 15.5 is the sum of all of these. Government's own receipts is this much amount of money. Non-debt capital receipt. Non-debt receipt is a sum of 3. So it will come under non-debt capital receipt, which will also be a part of non-debt receipt. No, formula, of course. தெரியுதா? It's just I made up this formula. So fiscal deficit is equal to total expenditure minus total non-debt receipts. Total non-debt receipts. And what is non-debt receipt equal to? It is equal to RR, revenue receipt, plus NDCR. I write it in this form because this is how we write the formula of fiscal deficit. Fiscal deficit is equal to total expenditure minus RR plus NDCR. Same thing. Shall I erase? So expenditure of the government is the same table as chart as previously. Capital expenditure separately and grants in aid together. We have seen all of these things. Composition of expenditure, composition of revenue and capital expenditure, where this is given separately. The blue one is the grants in aid, effective, the component which gets added to the effective capital expenditure. So that is, all of these are just graphical representation of that. Trends in capital expenditure, they have given capital expenditure and grants in aid, and what we see is a marked improvement starting from 2019 onwards, significant increase in the capital expenditure on the part of the government. And we are seeing that the grants given for capex is also substantially increasing. After a period of relative stability, there has been a reasonable jump, especially the current allocation. Previously it was around the range of 2, it went up to the range of 3%. Now, not percentage, lakh crore, now it is around 5 lakh crore, which is a big jump in this particular proposed budget. Okay, again, observations. Again, what you have to interpret is how the pattern has changed over the years. Is it consistently increasing? Is grants in aid as a part of capital expenditure, effective capital expenditure, consistently increasing? No. 3, 2.7, 3.1, no consistent increase there. Observations, these are observations. I don't know who's the RCB fan here. Okay, so capital expenditure as a same. What is the difference between this? Okay, that is in absolute terms, this is as a percentage of GDP. That's all. Okay, so here is a portion where they have categorized the expenditure on major items, pension separately, defense separately, subsidies again broken down into many, education, agri, all those are, this is the place from which we can get this data and convert it either as a percentage of total expenditure, but more commonly convert it as a percentage of GDP. How much money is the government spending on education as a percentage of GDP, healthcare as a percentage of GDP. These are interpretations that we can make out of this, on energy or very specifically rural development, because there have been questions in the, there has been one past mains question which says, discuss how government's expenditure on social sector has increased in the post-reform period. Okay, post-reform period is post-1991. We may not be able to give, that's a 10-mark question, okay. We may not be able to give data from 1991, this was the case, 2000, this was the case, we may not be able to. But we can, if we can use some data saying this percentage of GDP spent over here, and if you can, if possible, learn the equivalent value in just 1991. What is relevant in 1991? The reforms that happened, right? And that was a landmark reform in India, which could have resulted in social sector getting completely ignored, because we were not becoming more socialistic, we were becoming more capitalistic. We are more, it's a mixed economy aligned towards capitalism. So what tends to get compromised there? Socialistic necessities, social development might get compromised. To show that that is not happening, if we can remember the data from there, that could be a very useful data. There are some key timelines that you can remember in the Indian economy. One is 1991, one is the 1960s, mid 1960s, Green Revolution, the success of Green Revolution. You can break down into independence, Green Revolution, 1991, LPG reforms, and the present. Any information that you can remember for these 4 timelines, a generalized average of at the time of independence, 1965, 1991, and the present, that will cover every base. Any information that you have to write, any kind of question, it will be covered in that. Plus, if you are analyzing certain schemes or certain measures that the government has brought in, for example, GST. At most, what can they ask? How effective has GST been in generating tax revenue? What was tax revenue in 2017 when GST was introduced? So till 2017, what is the tax revenue now? Just these 2 timelines. So whenever you have landmark events happening, if you can remember data from then in comparison to the present, if you can remember, and these are not things that you have to do now. What I would suggest to you is, make a note that these are data that you have to learn, but learn the data after your prelims examination. Okay, because you learn now also, remembering it is going to be very hard. Once your preparation becomes entirely main centric, that is when you have to remember this kind of data. What you have to do now, even with respect to all of these, is Remember that these are the information that you require at that point of time. Make a list of the information that you have to gather closer to the examination, not gather the information now itself, because it might become irrelevant by the time you write your examination. Only prelim centric information like these trends you can make a note now. Main centric after your prelims, when you prepare for the test series, then take a list of all the data. Okay, this is the data, this is the data, and then memorize it at that point of time. Not exact numbers, but rough values is good enough if you can. Okay. Are you asking how much money should be spent is decided on what? Based on the needs in the particular sector and based on their ability to pay for it. So if you look at need, there will be a need for double the amount of money probably. They'll also look at what are the various sectors, how much is the money that we have, how much can we collect as tax, how much can we borrow while we are sticking to the FRBM regulations or our own regulations. They have a income generating capability or money generating capability. There is an expenditure requirement. They look at that. They look at past trends. They look at how efficient these sectors have been in using that money. Based on all of those, they'll allocate the money. So this is the logic that they follow. And it takes quite a bit of time. That's why budgeting starts in October. October, November, December, January, end of January. Close to 3-4 months they spend on doing all of these in terms of allocations. Okay. And in India's case, our budget is also performance oriented. When we allocate funds, we will look at last year we allocated funds, how effectively have they used it? If they have not used it, if there is some leftover fund, if their achievements are poor, then we might withdraw funds from that and direct it in some other direction. Okay. Yeah. Coming to the final major area of this particular document, outlay on major schemes. What all schemes are mentioned over here? Any scheme whose funding is greater than 10,000 crore plus new schemes. So only schemes with more than 1,000 and new schemes, only that many is, oh last year 150 there, 191, 191 schemes. I've already told in class, you don't have to memorize all of these things. Look for two things. Look for schemes which are newly introduced, such as Maritime Development Fund, Scheme for Capacity and Capability Development, Shipbuilding Financial Assistance. Maybe not all of them, but depending on what is relevant, you should be aware of these things. Look for big amounts of money over here, even with respect to this. Scheme for Allied Health Professionals. What are Allied Health Professionals? Scheme for Entrepreneurship Development. So that is a criteria that you can use, which means the new schemes. In the heading they had said new schemes, no? Bio, Pharma, Shakti, Chemical Parks, all these are newly introduced schemes. Okay, how much ever of these you can remember. There is also another place from which you can get all this. I'll tell you about that also. Look at this. There is some scheme 000 95,692 crore. Which scheme? VBG Ramji. Okay. So that is one logic. New schemes, make a list of it. Let's say there are about 20 schemes. Don't read all 20 schemes. From that, shortlist say 4 or 5 schemes which are very relevant, which can be used across multiple subjects. For example, it can be used in social justice, it can be used in sociology, it can be used in ethics, if there is an Indian example that you're giving. Plus, it can be used in maybe science and tech, border defense, or of course economics. So in all of these areas, commonly usable across these, look at the syllabus, look at which aligns with that, only those schemes try to memorize. And then schemes with allocation more than 1,000, look for 5 or 6 digit numbers. This 8,500 and all those will come to later. Krishi Unnati Yojana, Samagra Shiksha, Pradhan Mantri Poshan Shakti, all these are 5 digit numbers, which indicates the allocation. 42,000 crore, everything is in crore, right? So 42,000 crore, which is a big sum of money that is allocated to that. In the context of that 1850 crore, these are all important as well, Uchatar Shiksha Abhiyan, but in the context of that, if you are shortlisting, obviously you won't be able to study 100 schemes, right, for the exam. Can you? Okay. I'm assuming you can't. If you are someone who can, then don't worry about all of this, study everything. But if you are struggling to, this is how you shortlist. Eventually, you will get to somewhere around total new schemes, old schemes, cumulatively, say somewhere around 20 to 25 schemes, which itself is going to be a challenge, but have a half-page note of these schemes. Note down the schemes first of all, and then keep yourself a target like I'll study one scheme per day or something like that, where you go to that particular website, official, whichever ministry is involved with it, and before you make notes, please look at previous year questions as to what can they ask as a question if they ask a scheme based question in prelims and in mains, because without that you will think everything about a scheme is important. So you need to be aware of what kind of questions can UPSC ask. Will they ask question on what date was the scheme launched, how much money is allocated as funding for that scheme? Are they going to ask those questions, or are they going to ask which is the nodal ministry involved for that particular scheme? What are the objectives of the scheme, or what have been the achievements of that scheme? Achievements most likely means question. If a scheme has been in existence for last 5 years or 10 years or 20 years, what are the drawbacks? Like what are the drawbacks of MGNRG which has resulted in the creation of a superior, more beneficial scheme called as VBG Ramji. Okay, wow. YouTube live. Okay, so this has to be analyzed. Okay, this has to be analyzed. I am talking purely without any analysis, but you should be doing that analysis. Could be a possible mains question. Okay, all right. So that is how you shortlist. Maybe around 25 schemes if you can, give and take a few. Again, your logic has to be you should learn as many schemes as possible which can be used across multiple areas like social justice, economics, science and tech. Across these cumulatively, total you study these many schemes, 20-25 schemes, you should be able to give an example in all places, plus any prelims question which comes from that area, any mains analysis which is asked from the area, all of it you should be able to cover. You'll have to shortlist, and the logic for that is that, okay, they have categorized it as centrally sponsored schemes as well as 30, how many schemes? No, 45 centrally sponsored schemes and central sector schemes, which is the rest of it, where the central government is taking care of 100% of the funding, central sector schemes. But again, why have they added the word major is because any scheme with less than 1000 crore, they have not included over here. Here they have not mentioned major, so I am assuming all centrally sponsored schemes are given over here. So that ends our discussion of the budget document. What they have done in the end is just the same things that we have learned previously. They have given it in the form of diagrammatic representation. Okay. Any questions? Class is not over. There's just one document that is over. All right, so we will move on to the next area. Do you guys are you guys expecting a break or something of that sort? என்னது? Yes sir. 6 மணிக்கு போக வேணாமா? Now I am confident that class will go at least till 6 o'clock. You want a break? How long? You know that no one is compelling you to be here. You will use this as an opportunity to go. Okay. Be back in 10 minutes. We'll resume in 10 minutes. 12 minutes. 3:50 we'll resume. All right, so we will resume. I was just waiting for a few more to come, but we'll start anyway. So we are going to start with the discussion on Finance Commission. There are two things that I'm going to be discussing. I'm going to be, okay, that was a while ago. Am I audible now? People online? I was talking to a couple of students here. That's why I had not turned on the mic. Yeah. So there are two things that we are going to discuss with respect to the Finance Commission. One is the Finance Commission's recommendations itself. And second is how has the government looked at the Finance Commission's recommendation and what is the government's response to that? We are going to look at that. So first we look at government's explanation with respect to the actions taken. Then we'll go into the actual recommendations of the Finance Commission itself. Because this is the shorter document, it can comparatively easy to cover. First, the first key takeaway for us is Finance Commission's vertical devolution. What is meant by vertical devolution? So whatever is the net tax revenue of the center, of which certain amount of tax goes into what is called as the distributable pool, which is called as net proceeds, which means effectively cess and surcharge will be removed and the remaining amount of money will go into the distributable pool of funds. Okay. By constitution, this amount has to be split between the center and the states. So center will keep a certain proportion of the money with themselves and the remaining will be given to the states. If we leave it to the center, what will they do to decide? They'll say we'll keep everything. They might say that. So to prevent that, the constitution itself said a finance commission has to be set up once in 5 years or sooner if necessary to give recommendations on how the split is to be done. So this split between center and states, certain proportion should be split and given. That is what is referred to as vertical devolution. Vertical because center is at the top, power wise center is superior, state is secondary to it. So that is a vertical devolution. The 15th Finance Commission had recommended sharing 41% of the net proceeds with the states. 15th Finance Commission had said that. 14th Finance Commission had kept this number at 42%. Effectively, this 41 is the same as that 42 because when they said 42, there were 29 states in India. J&K and Ladakh lost its statehood, so that 1% was kept aside for J&K and Ladakh, and 28 states got 41%. So practically they treated it like the same share. Although numerically the number is different, they are treated like the same share. 16th Finance Commission has also retained it as 41%. No change in that. During the discussions that were taking place, there were states asking for 50% of the shares to be given, center saying reduce it even further. They ultimately said this is, we'll retain it that level itself. So the logic reasoning on all this is not necessary. The fact is what that is necessary. So 41% is the vertical devolution. It continues to be so. Okay. The commission has recommended that. The commission has recommended to bring in more transparency about the divisible pool and the actual devolution every year, which means states are a lot of times accusing the center saying that you are not very clear about how much is your tax, you're not giving us that data properly with respect to how much you are receiving as tax and how much is going into the net proceeds and all those things. So there is a CAG certified process of doing this, Comptroller and Auditor General. So the center has been advised by the commission to align with the CAG standards and present the net proceeds data in that manner. The government has accepted the above recommendation. So this is again, consider the following statements about Finance Commission. This recommendations, one in some form, in a simplified form, could be given as a statement. Okay, center has been mandated to align with CAG standards of reporting when it comes to net proceeds. Could be a factual statement that they give. So just be familiar with that. Okay. All right. Now coming to horizontal devolution. Horizontal devolution. The criteria of per capita income distance has been retained. This is what we call as the income distance criteria. Last year we continue to have that. Last year it was, when I say last year, last finance commission, there was a particular split. We look at the split difference a little later. Okay, so that criteria remains. The other criteria that was there was a criteria called as tax and fiscal effort. Okay, the tax and fiscal effort criteria has been replaced by contribution of the state to GDP as a criteria. So this is a new criteria, and usually when new criteria is introduced, that becomes very important from the exam point of view. This year prelims, almost certainly there is going to be a question on this criteria or something to do with the finance commission and its recommendations. Almost certainly it should be a surprise if they don't ask a question, because every year when the economic survey, when the finance commission's recommendation is given, immediately after that in the prelims they ask a question. Sometimes they don't ask to defy expectations, but you should go prepared with respect to what are the additions and all those. If you're not prepared, you are likely to miss out on marks. Almost certainly a question will come. In what form we don't know, but a question with respect to finance commission is going to come. Then population is a criteria that they had last time, that they continue to have this time also. Demographic performance is a criteria that they had last time, they continue to have this time also. Last time there were 6 criteria, this time also there's 6 criteria. Area is a criteria that they had last time, they continue to have this time also. Forest is a criteria they had last time, it was called as forest and ecology, now it's simply called as forest. It's a criteria they continue to have this time. However, there have been some changes in how the criteria is calculated. So what is the one new criteria that they have introduced? State to GDP, but they may also include forest as a separate criteria, because there is a fundamental difference in how it is calculated. So keep that in mind also, because previously the 14th Finance Commission had a criteria called as forest cover, and the 15th Finance Commission had a criteria called as forest and ecology. In terms of how the calculation is done, there was a slight difference, and UPSC asked a question saying which of the following are newly introduced criteria, and they included forest and ecology in newly introduced criteria. Because there is a name in the there is a difference in the name, so treat this also as a newly introduced criteria, forest, because there is a substantial difference between forest and ecology and forest in terms of how forest is measured. So how much which state is getting is going to change because of that change in definition. So look at it that way. So 6 criteria more or less the same. Weightages have changed. So we'll talk about the weightages in a little bit. I'll take that separately as a table and explain it to you. What has it replaced is it? Tax and fiscal effort was used to be the criteria in the past. Tax and fiscal effort, which accounted for only 5%, 2.5%. Then, if I'm not wrong, this has been given a weightage of 10% now. We'll discuss the weightages separately. We have a table to show that. This has been replaced by contribution of state to GDP. We'll discuss that in a little more detail. This horizontal devolution criteria, we'll discuss it a little more separately. We are just looking at the overview now with respect to horizontal devolution. The government has accepted the above recommendations of the commission. 41% has been accepted. Horizontal devolution criteria has also been accepted. No variations in that. Okay. Now, questions that have been asked in the past. The 16th Finance Commission, I'm just saying as an example, the Finance Commission, the new Finance Commission has recommended sector-specific grants, state-specific grants, revenue deficit grants. These are words that they use to, these are the kind of statements that they might give in the examination, saying that this has been newly introduced. And why do they ask question like that? Because very specifically they are writing, the Commission has not recommended revenue deficit grants to states. So in the exam, if they want, they can ask the 16th Finance Commission has recommended revenue deficit grants. So you should know it has not, because they have highlighted that they have not recommended. Similarly, the Commission has not recommended sector specific or state specific grants. It has not been recommended by the Finance Commission. The fact that it is not recommended is very, very important, because they might give a statement saying it is recommended. It has happened. They have asked a question at, when the 14th Finance Commission in 2015 had given a report. Immediate year after that, they asked a question saying they have given sector specific grants. I think they had not given at that point of time. So those kind of errors they might ask. Okay. Or they might say they have refrained from giving any sector or state specific grants. Correct statement. They could give it that way also. government has taken note of the above assessment. There is nothing to agree or disagree. The government has just observed it. That's all that is there. But they have given certain grants. Majorly two types of grants. One is called as the local body grants, which was there last time as well. This time also it is there. Very specifically, they segregated into rural local body grants and urban local body grants. Okay, if you want, you can go further deeper into it and analyze what these types of grants are. I wouldn't really suggest that in the first instance, at least. That should not be your first priority. After you have got the overview of the Finance Commission's recommendations, if you have the time and the understanding and the patience, you could go further and go deeper into criteria behind it. So there is quite a lot. There's a 60-40 recommendation, basic and performance and all those things. Those will get very, very specific, very, very narrow and specific. At this point of time, I wouldn't recommend you to go and read all of those things. That will only make it very complicated for you. So just look at the overview, what I'm giving right now. But if you want, you can go read further. There's a 60-40 split. There is an 80-20 split with respect to basic and performance criteria. All those things are there, which I am saying at this point of time, I wouldn't recommend you focusing on those. So there are some conditionalities for grants also. They have mentioned all those. Again, at this point, I wouldn't recommend you to go and memorize all those conditionalities. To be given grant, the rural body must be having a proper accounting system. All those things, those are conditionalities. Not at this point of time. Okay. Maybe later we'll have a summary of all of these things, a simplified crux version of it. Gets too technical, this part of it. Okay. So these are all this 12, 13, 14, all of these are recommendations under the heading of local body grants itself. Now we come to government has accepted the above recommendations, financing of disaster management. This is the second type of grant. One is local body grant, the next is disaster management grant. These are the only two additional grants that have been given in addition to the horizontal devolution, vertical and subsequent horizontal devolution. Disaster management. Again, there are some sub criteria inside it that if a state hasn't used its disaster management for a 3-year timeline, then the center can withhold its disaster management fund for some time because it's not being used. It's not, there hasn't been a necessity to use, right? So all those are mentioned over here. Again, too soon to go further into depth of that. Has accepted the above recommendations. Okay. Then they have also given, this is not about grants, it's about a pathway with respect to macro and fiscal stability. Okay, they have highlighted a few things. The commission has recommended, these are potential questions again with respect to the recommendations of the commission. The commission has recommended the state's fiscal deficit should be capped at 3% of the respective GSDP. Okay, and to ensure the stability of debts to state government, they should be strictly enforced in accordance with the constitution. That is with respect to state. They have said the state should reduce its fiscal deficit to 3% of the state's GDP. Like we have in the fiscal FRBM target and all this. This is for the state. Finance Commission is saying so. Union government should reduce its fiscal deficit to 3.5% of GDP by the end of the award period. Which means by 2031, the center should ensure that its fiscal deficit is 3.5% of GDP. That is not center telling itself. That is not center giving a commitment. Finance Commission is telling the center you should be doing these for sound fiscal management. We have to see whether the government has accepted this recommendation or not. Okay. The commission has recommended states should completely discontinue the practice of incurring off-budget borrowing, which are not recorded in the budget, and any such borrowing should be brought inside the budget, so that states don't take the loophole of borrowing in some other. Typically, off-budget borrowing works this way. They'll have a PSU or they'll have some other department. They will borrow without it being explicitly written in the budget. Okay, this became a controversy in a couple of states. One state started an infrastructure organization and that organization borrowed from somewhere else and it did not report in its budget. Okay, that becomes, again, ultimately the liability falls on the state itself, right? Because that organization is owned by the state. So these kind of borrowing should not be allowed at all. The commission has recommended state should completely discontinue the practice of incurring off budget, and any such borrowing should be brought under the budget. Suggested a format for reporting off budget borrowing as well. The commission has also, it said, recommended that lending institutions should provide an alternative source, which means the lending institutions are now given an objective that if you have given a loan to the state, come and report it to us, so that we'll have multiple sources of getting to know about state doing such borrowings. That's a recommendation. the Commission has recommended that fiscal responsibility legislation, FRL, is the equivalent of FRBM Act for the center. For the center, we call it as FRBM Act. For the state, we call it as fiscal responsibility legislation of the respective states. The Commission has recommended that fiscal responsibility legislation framework of the states be amended. Already it had been implemented based on past compulsions. It be amended to bring uniformity and remove inconsistencies and align them with the fiscal consolidation roadmap of the Commission. So states should substantially make changes to their equivalent of FRBM Act and make sure that all the states are in a common sync, and it should be in alignment with the fiscal consolidation roadmap of the Commission. What is the fiscal consolidation roadmap of the Commission? Of 3%, fiscal deficit target of 3%, they said. No, to align with that, they should bring it. Now here is the government's response. The government accepts in principle the recommendation of quantum expressed as a percentage of GSDP of net borrowing ceilings of the states. So 3% of GSDP of the state, they have accepted it. Okay. Other recommendations of the Commission, including those related to off-budget borrowings, amendment of state FRLs, union government's fiscal deficit, will be examined separately. In due course, they look at whether to implement it, to what extent it can be implemented. That's what, very explicit with respect to all of these. No hiding, no, not commenting on that. The government has commented saying that we need more time. They presented their budget only in November 17th, or not the budget. They presented the report only on November 17th, Finance Commission. Okay, and the budget was presented on February 1. Okay, so there hadn't been probably for these matters enough time for the government to look at the practical applicability of, see, you have to go to every state and ask them to amend their law, FRBM law. You have to see what is the practical possibility of that, right? They can't just blindly say, oh, we'll accept all of these agreements. They have to read this further. That is what they are claiming, that they will take some time, look into it, and then based on the practical applicability, they will implement it. Okay. So there are a couple of other recommendations also. The Commission has made other recommendations, including rationalizing the structure of centrally sponsored schemes. Okay, centrally sponsored means what? Both are sharing, right? Now, 14th Finance Commission gave how much to states? Vertical devolution? 42. This was a landmark change because the 13th Finance Commission only had 32%. Look at after 14, 15 is 41, 16 is 41. Look at before 13, 12 was around 29, 11 was around 28.5. That is how the changes were happening, right? Marginal changes, if at all. Huge jump from 32 to 42 happened in the 14th Finance Commission. But that 14th Finance Commission actually had given a suggestion that this centrally sponsored schemes, right, that 60-40 should be changed to like something like 40-60. What the states were asking was that all of the grants given by the center is tied to some scheme. They'll give us a grant provided you implement the scheme. And many of the so-called developed states had a problem with this. The problem that they had was, if you are giving a grant, a scheme, you are launching a scheme like basic education scheme, okay, Prathmik Shiksha Abhiyan or something like that, and you are giving grant to states saying that you must use it for enhancing your primary education. A state like Kerala or Tamil Nadu might come and say, we have already achieved all those objectives. But the center says, no, we'll only give money if you implement that. So then there is no scope of getting this money. So the states went and argued saying that we should be given more money which is unconditional in nature. And these Finance Commission grants are unconditional. This vertical devolved money is unconditional grant. So they raised the unconditional grants, but they told the center, you reduce the conditional grants. You reduce your contribution. Instead of 60-40, make it 40-60 or 50-50 or something like that, which was never really fully implemented, which is what they are still talking about. Centrally sponsored schemes, included those on rationalization of the structure of centrally sponsored schemes. They have recommended rationalizing, which means making sure that the center is not bearing too much of the burden of that. Okay, reforms in the power sector, rationalizing the reforms in the power sector, then containing and making subsidies efficient, how to do that, public sector enterprise reforms. About these also they have given recommendations. In depth, these recommendations we'll only get to know once we go inside, which we are not going to go into that depth. Again, because the government has not fully accepted it either. Government will examine these recommendations in due course. That's what they have said. They have not blindly agreed to this either. And finally, we are talking about the implementation. Orders on the accepted recommendations under Article 270. relating to share in union taxes, duties, grants to local bodies, financing of disaster management. So that is given, will be issued after obtaining the approval of the president. The recommendations related to path to macro and fiscal consolidation, that 3%, 3.5% and all those. Power sector containing making subsidies efficient, public sector enterprises and other recommendations of the commission will be acted upon in due course. So this ends the document that the government has given with respect to their actions on the Finance Commission's recommendations. So this is one document. We will now take a look at the actual recommendations of the Finance Commission. I have directly taken the page. This is page number 193 out of 364. I've directly taken the horizontal devolution recommendation. After this document, I'll show you where I got all these documents from as well, where you can download these documents. Right? I'll show that to you. You can download it and keep it with. But for now, make a note of the page number. That is this PDF page number. 171 is the page number as per the document, where you can find this table 8.8. Okay. So they have given in this case population as the starting criteria. There is no logical order to this. So population as a criteria based on 2011 census has a weightage of 17.5, which continues to be the same as last time. Last time also it was it 15 last time? It was 15. It has been increased to 17.5. So this is also a potential question. Change in weightages. Which of the following criteria have seen a change in weightage? Or they'll say consider the following statements about Finance Commission. The weightage of population has increased from 15 to 17.5, or the weightage of population has been left unaltered. These are the kind of statements that they'll make. So you should be familiar with any changes that happens. You should be familiar. No change also you should be familiar. So this 15% has been raised to 17.5%. That's a significant change. Okay. Demographic performance, which was 12.5%, has been reduced to 10%. So practically overall population weightage has not changed. 27.5. 17.5 plus 10, 27.5. 15 plus 12.5, 27.5. The amount of money kept aside for the general criteria called as population is remaining the same. What has changed is now more money is given to the states with, it is a little critical to say states with high population, more than that the states which are in greater need of money because of the excess population that they are having. Okay, they have been given a greater share. Okay, I'll tell you that. Okay, I'll answer that question. And demographic performances, how efficiently they have managed to control population, that is a criteria. That is now getting a lesser weightage, which obviously would anger some states which have managed to control their population well, but that is how it is. Okay, so I'll just quickly answer that question. So let us say, first things first, the term that we need to understand is net proceeds. Net proceeds refers to the distributable share of the center's tax revenue. Let's say the center has collected a total tax of 300 rupees, okay, 300 rupees, of which about 40 rupees is in the form of cess and surcharge. So cess and surcharge is not distributable, so removed. We are left with 260 rupees. Out of the 260 rupees, let's say 10 rupees is the money spent on collecting the tax. The total expenditure on collecting the tax, that will be removed as well, because that need not be distributed. So we are left with 250 rupees. That is the net proceeds, distributable share of center's tax revenue. This is the net proceeds, out of which 41% is kept aside for states. Okay, 41% of this would be 102 rupees 50 paise. Okay, 41%. So how much will the center get? 147 rupees 50 paise will be in the center's hand. 102.50 will come into the state's hand. This is vertical devolution. Okay, but for simplicity, let's assume that this is equal to 100. So 100 rupees is now available for 100 is actually 40%. For simplicity, I'm assuming it as 100. Now 100 rupees is there to be distributed among all 28 states. It should be distributed among all 28 states. So the question that is confronting the finance commission is, how do we distribute it? Can we just divide it by 28 and give everyone equal money? Obviously not, because the requirements will be different. So we are asking, before we divide it among states, let's first create a criteria based on which the division can be done. These are the criteria. Okay, and under each of this criteria, the 100 rupees that is there, no, the 100 rupees itself will be split as 17.5 for the criteria called as population. So if 100 rupees is there, 17 rupee 50 paise will be given for the criteria called as population, 10 rupees for the criteria called as demographic performance, 10 rupees for the criteria called as area, 10 for forest, so on and so forth. Okay, this is the logic. And then now the other question comes, this 17.5 for the criteria called as population, right? How will that be distributed among the 28 states? Under each of this criteria, all 28 states will get money. Every single state will get money. So under the criteria called as population, what we do is, we take in the denominator the sum of people living in all 28 states. UT is excluded. UT is not part of this. UT's funding will directly go from center. So sum of population of all 28 states in the denominator, and in the numerator will be the population of that particular state based on 2011 census. Okay, so that will tell us what percentage of the population is living in that particular state. Similarly, you do it for all 28 states, the sum of that will come to the total population of the 28 states, which means it is converted to percentage, and the sum of percentage will be 100%. That is equal to the 17.5. So 17.5 rupees in this example will be distributed. Let's say 5% of the population lives in Tamil Nadu. Then Tamil Nadu will get 5% of this money, 17.5% of 100 rupees, which is 41% of the net proceeds. Okay, so if 5% of the population lives in Tamil Nadu will get 5% of 17.5% of 41% of net proceeds. That is the logic. For simplifying it, 41% of that is roughly 100, 17.5% of this 17.5, 5% of that is Kerala. Okay, so that is what it is. Which will affect the development? Very good question. Should have asked Finance Commission. Why do you think it affects development? Very good. So what the Finance Commission says is, there are two criteria, broad criteria based on which they divide money. Okay. Just 1 second. This heading conveys that two criteria. So Finance Commission says, every Finance Commission, from the time India started having Finance Commissions, the Finance Commission has been guided by two criteria: equity, efficiency. These are the two criteria. Okay. By equity we mean, what do we mean? End result of equality. Okay, I have some money, I divide it equally and give it among 5 people, that is equality. I'm treating everyone equally. But let's say one of them is a disadvantaged person due to some reason, some kind of a disadvantage. Maybe the circumstances did not allow that person to get proper education. Okay, the circumstances did not allow that person to get proper education, and so has lesser income earning capacity. Yes, some kind of a disadvantage is there. That person constantly had to deal with fights in the household. I'm talking about states which are closer to enemy territories, which constantly has to deal with some kind of a conflict that is happening over there. Okay, or states which are closer to, or which have very high mountainous regions and all those things. Obviously, we cannot treat all of them equally. Some of them has to be given a greater support. Okay, that is what is equity, where Our objective is at the end of it, we expect them to become equal. Okay, we are not treating them equally, we are treating them unequally so that they'll end up becoming equal at the end of it. So that is one objective. The other objective is efficiency. We have given some funding or you are doing something, how efficiently are you doing it? Okay, take the population criteria. In population 2011 census, we are saying that our priority is equity. Okay, these states which are having a higher rate of population, right, higher number of population right now, right, if we are making a claim that, let's say, a southern state which has managed to control its population well versus a northern state which has not managed to control its population well, just to give an example, okay, I don't want to pick particular states, you are saying that look at them, look at their high population, look at our population, look at our fertility rate, it's much lower, look at their fertility rate, much higher. We'll ask one question: when you started, did you start from the same point? Did you start at the same level of fertility rates to begin with? No, clearly not. Maybe some of these states which have a low fertility rate now, right now, let's say fertility rate is 1.4 or something, you might have started with the fertility rate of 3 or 3.5, but they might have started with the fertility rate of 6, which they may have reduced to 4 or 3, 3.5 now. Whereas you started from 3 and you have reduced it to 1.7. So you did not start the race at the same point. Say, let us say you started at the same point also, your other circumstances were not the same. To promote family planning, first education is necessary. Because if you are not educated, you look at children as an asset for working in the farm, as a future labor force. Okay, we have more children, we have more people to work. And also this mindset change that a lot of people have, couples have children till they eventually achieve the success of having a, shouldn't be saying it, but that is how they perceive it, a boy child. So they'll keep having children till they have a boy child. But it is only education and literacy which will convey to them that that is not necessarily the yardstick of how they should go about this process. So all these literacy levels, they did not start at the same point. These different states did not start at the same point. So to convince the people to control the population, it's not state dictating it, right? It's people themselves changing their mindset. It is much harder in a state where education levels are lower and much easier in a state where education levels are higher. And at the time of independence, there were inherent differences. Now, these many years later, now you say, no, it's time to treat everyone equally, not equitably. That is not necessarily fair. Hence, greater money is given. So it used to be like this. But population explosion was a problem, huge growth in population. We said to control population, we are going to fix it at 1971 levels. All subsequent grants given will be based on 1971 population. That is how the decision was, to prevent population growth. But the current reality is that the states which have high population are suffering the consequences of the high population. Now, if you are going to penalize them by saying that, hey, you should have control population, look at the state, it's like someone who had some kind of an advantage who managed to do it well. Should you penalize someone who has not performed well? And penalizing a state means that penalizing the people living there as well. Imagine that it's one of your relatives living there. You wouldn't want that happening. Migration தப்புன்னு சொல்றீங்களா? No. That is an entirely different discussion. We can go on and on about it. But the principle of equity says that sometimes, even if we are distributing money on the face of it unequally, the intention is that eventual equality we should be looking at. That's one. But simultaneously, they are also looking at efficiency as a criteria. How efficiently have you fulfilled certain objectives that you have taken up, like population control? That is why we have a criteria called as demographic performance itself. Okay, while you might say, but demographic performance is losing out by 2.5 percentage points, you notice that last time, we have not discussed that yet because he asked the question, I took up that. Last time, the tax and fiscal effort only had a weightage of 2.5 percentage, which is like bare minimum. This time, percentage contribution to GSDP is having a weightage of 10 percentage, which is a significant improvement in efficiency criteria. If you are efficient with respect to your actual economic activities, you are being rewarded more. Last time that was almost negligible, the 2.5. Now it's substantial, 10 percentage. Okay, that is an enhanced, that's a reward for good performance. So the Finance Commission has to balance its two priorities being equity and efficiency. Okay, now we'll get back to that table. Okay, so demographic performance, this is increase from 15 to 17.5, this is a decrease from 12.5 to, okay, I'll write it on the same side. So 12.5 to 10. The criteria called as area has also reduced. Last time it was 15. 15 has been reduced to 10, but no change in how the calculation works out. It is still the same. Denominator, total area of all 28 states, numerator, area of that particular state. More area, more infrastructural requirement that is there, but they are looking at something else. Okay, again, contribution to GSDP, performance. Because if you have actually built more infrastructure, you will obviously be contributing more to GSDP. Again, area is a default kind of a criteria, an equity criteria. More area should be given more money. We are taking away some of that and saying we are going to make it performance based, efficiency based, which is where the contribution to GDP becomes a significant factor over there. Forest criteria remains at 10 itself. Last time also it was 10. This time also it is 10. But last time it used to be called as forest and ecology. The difference is, last time they only took dense forest into consideration for forest and ecology. It has to be dense forest. Okay, if the forest cover was only moderate, sparsely distributed trees, or open forest, which is not properly in the form of a forest but very sparsely, so there is a tree here, there is a tree there, but it is practically in practice like a forest land, but it doesn't get that category of dense forest. Those used to be ignored under the heading of forest and ecology last time. Only dense forest was considered. So many states went and said, this is also forest land, we are not able to use it for any other purpose. If you have to cut down and use it for other purposes, then that will mean less forest cover that is there. The Finance Commission took this into consideration and said, we are going to derive a formula by which we are going to categorize forest land into dense, moderate and open, and we are going to assign weightages. Dense forest will obviously have a higher weightage, moderate will have a lesser weightage, and open forest will have a lesser weightage, but all three will be taken into consideration, and we will treat all of them as forest for the purpose of granting money. So the percentage has not changed, but the definition of the criteria of forest has changed. So that's practically like a new criteria. The name itself is different. Previously it was forest and ecology, now it's only forest. Okay, so that has to be treated, I believe, as a new criteria. Okay, that is 4 criteria done. Per capita GSDP distance. It's just a naming convention difference. Of course, there is a slight change in how the calculation happens as well. I'll tell you about it. Last time it was called as income distance, but per capita GSDP is nothing but income. Last time it was called as income distance, where I had to explain in class that the income is indicated by per capita GSDP. Now the name itself conveys. You don't have to ask the question what is meant by income. So per capita GSDP distance. Okay. Last time the criteria had a weightage of 45. It's been reduced to 42.5. Is this an equity based criteria or efficiency based criteria? Equity based criteria, because per capita GSDP distance, it is not per capita GSDP. Okay. It is not the per capita GDP of the state that is considered. It is the lack of per capita GDP of the state which is considered. Okay, income distance criteria means we arrange the 28 states, state with the highest income, state with the lowest income. Okay, how much is the gap? That gap indicates the poverty in that state, the absence of income in that state. The greater the gap, more money will be given to them. That is how it used to be. So it's a criteria to support poverty, which means it's an equity criteria. Okay, that weightage has been reduced from 45 to 42.5. Once again, lesser weightage given to that. Okay. So that is how the criteria is. It continues to be like that. Top state, 28 state, the gap between them. One crucial difference in the calculation is, instead of taking only one state there could be differences in a particular state at a point of time. 2 states, I think Goa and Sikkim, they are very small state. Obviously their per capita is going to be quite high. Though those states have been ignored. I think at the top we have Karnataka, Haryana, and one more state, I forget. I open this in the calculation, I can find there's a 3rd state. The average of these 3 states is taken as the top, not just one state. The average of the top 3 states is taken as the top. Then their gap to the 4th state is there. No, that gap will be given equally to all 4 states. So every state will get money. The average of the first 3 states is kept as the yardstick, and the gap with the 4th state, that much amount of money all first 4 states will get, and then progressively every state will get the gap between this average value and their state. So proportionately, again it continues to be the same. The greater the gap, the more the poverty or the more the absence of income, and more money will be given to them. So it continues to be distributed that way. Okay, again if they want, they can ask this technicality that the average is the upper limit is kept as the average of the top 3 states. They won't particularly name states, I don't think, but it will be, if at all it's very technical, I don't see that likely, but if at all they ask, because in the previous one the upper limit was set as the highest state with the highest per capita GSP. Now it is the average of the top 3 states. Okay, that's all the differences, otherwise no difference there. Again, this has also come down. Okay, these are criteria where which states will get the benefit. The poorer states with more population will get benefit. Once again, population is sort of getting rewarded in two sense. There more population, here more population means lesser per capita income, no? You are dividing by a greater value, and lesser per capita income, greater gap between the topmost state. So more money will be given to them. Throughout our last many finance commission's recommendations, it has been predominantly skewed in favor of equity and lesser for efficiency. Now we are seeing a trend of efficiency gaining slightly greater significance, with contribution to GDP being a very significant factor that's been newly added. This is the highlight of this particular recommendation, is what I would say. Contribution to GDP, this was not a criteria earlier. If at all, maybe you can equate it to tax and fiscal effort. If you equate it to tax and fiscal effort, it's been raised from 2.5% to 10%. But it's not the same criteria at all. Tax and fiscal effort explicitly said of the total GSDP of that particular state, how much are they collecting as tax, their ability to collect as tax. That was tax and fiscal effort. Here in the denominator, we have the GDP of all 28 states together. Leave UTs again. GSDP of 28 states in the denominator. That's in the denominator. In the numerator, we have GSDP of that particular state, how much they are contributing. The greater the contribution, the more money will be allocated to them. So better performance is getting rewarded over here, and a substantial share of money is now given to them, which was never used to be the case with respect to performance criteria previously. Most of the times performance criteria were just nominal, like a pat on the back saying well done, 2.5% or 5%. Now it's a substantial amount of money that is given for good performance. Okay, so these are the new changes that have happened. You must study 15th and 16th, not just 16th alone, because the questions, at least for the next 2 years, are likely to be comparative analysis of 15 and 16. Not just with respect to this, you have to also take in the numbers of whether disaster relief grants have increased in volume or not, or local body grants have increased in number or not. That comparative analysis is also something that you should be doing. Okay. If you are interested in going any further into this and learning, I'll just leave it as it is if you are making a note of it. Okay. So if you need further information with respect to this, couple of things that you can focus on. This is not important. This is what is the share of each state in the overall. That 41% is kept aside for state. No, how is that 41%? Assuming that to be 100%, how is that? That 100 rupees, how is it distributed among the various states? How much is each state getting? That is what is the number over here. And in the newspaper analysis, what you would notice is they do a comparative analysis. Last finance commission, what percentage was there? This finance commission, what percentage is there? One highlight that was there in on the day of budget, on the day after the budget itself, was that southern states are now getting a greater share of the money, which is what the southern states were claiming, asking for as well. Give us a greater share, give us a greater share. Tamil Nadu has a bit of a concern there because their value has increased by only 0.07 or something like that, which is, but other states have seen a slightly greater increase in their, Tamil Nadu knows what it needs to do. Okay. So this technical note on horizontal devolution at the end of it, page 173, please don't go into it. But if you do go, you will get to know the calculation. Look at these numbers. Do you want to go into it? Good decision. But if you are interested, this is where they explain how the 6 criteria are calculated. The numerical, if there are people who are interested, this is where I don't see any reason why you should be interested for UPSC purposes. You are not going to write this as an answer anywhere. But if there is a curiosity which is creating an itch inside you, this is the place where you go and figure that out. Optional students that I'll deal with them separately. No, not required for them. This mathematics is not required for them. But what is required for economics optional aspirants if you are here? The 3 states are Telangana, Karnataka, Haryana. Okay, 3 states with largest GDP, and Goa and Sikkim have been excluded. So what is required? Maybe others can also look at it. It's not here, but prior to this, they have taken a bit of time explaining these criteria. That is something that you can also go and read. Without devolution criteria and recommendations, what is meant by population, how is the calculation done, just the explanation of that. This is page number 168, 167, 168. Reading this is good enough. Nothing beyond this is necessary, but this itself is a slightly excessive, but you will be able to understand. That is a good thing about this. That part I don't understand, so I won't recommend you to read. Enna C, enna code, I didn't understand that at all. Okay, so demographic performance, area, forest. I told you, right, that percentage is there. Everything, that level of depth is given over here. Weightage of 0.3 for open forest, 0.65 to moderately dense, and 1 to very dense. So that all those information. Per capita GSDP distance, how is it measured? Contribution to GDP, how is it measured? So that is all. And recommendations they have concluded with. So everything that you need to know about this and the 6 paragraphs about this will convey if you are interested in reading that, or just learn this. But learning this in the context of 15th Finance Commission is very, very important. Okay, not just horizontal devolution, even the other grants, disaster grants and all those things has to be looked at from that perspective. So that ends our discussion on Finance Commission. Any questions? Okay. So just one part before I move to next, I just typed on the browser Indian budget. The website is indiabudget.gov.in. The document that I'm accessing, if you are not aware of it, indiabudget.gov.in. The first document that I opened is this document, Budget at a Glance. Budget at a glance, and this document, Budget at a Glance full. That is a 23 or 25 page document where we had all the images, flow charts and all those things, not flow charts, whatever, block diagrams and all those things. The budget itself can be found there. If you want to look at them separately, they have given that here also. But if you want to look only at the numbers without all of those, the annual financial statement full, Consolidated Fund of India, it separately has details of revenue account, receipts, revenue account. If you want to get a complete detail, and at least once you should spend time looking at it to properly understand the budget. Okay, to go through each term, not to memorize any of those, but just to understand. Okay, I would recommend you to go through these either individually or as a document as a whole. I'd suggest that this document as a whole is this annual financial statement, or you can break it down into consolidated fund alone separately. Okay, I wouldn't say the other things are as important. And the document I just opened with respect to Finance Commission's recommendations here, explanatory memorandum as to the actions taken on the recommendations made by 16th Finance Commission. The first document I opened where the government what action it took, that is the first document, explanatory memorandum. And the second document that I opened where the page number 167 and all those I showed, that is volume 1. Okay, volume 2 is much greater detail into the calculations and other recommendations and all those things. Volume 1 is the one that I opened. These are the documents that I've used so far. Okay. Just 2 more documents for us to cover, and then we'll be done with the class. Okay, that's all that I have in plan. One of the documents is statements of fiscal policy under FRBM Act. The other document is budget highlights, key features of budget. Key features of budget is very densely populated diagrammatic representation. There isn't a lot to teach. I'm only going to introduce that to you, what is inside it, and just show that to you. That is practically like notes for you, because all the key things are given inside. You can just learn directly from that. Okay, it's only about memorizing that and using that as a source. Nothing much to teach there, but this one has a little bit of discussion to do. Statements of fiscal policy under FRBM Act. I think I had already opened it. Yeah. 16-page document. So the FRBM Act itself mandates that there are 3 documents that must be mandatorily published every year along with the budget. Macroeconomic framework statement is one, medium term fiscal policy is another, and fiscal policy strategy statement is the third. And also, if they are violating the FRBM Act, they should explain why they are violating the FRBM Act as well. These are the mandates that are there. We'll go one by one. Macroeconomic framework statement is very significant because it explains how government's budget is going to influence the rest of the economy. Okay, so we'll start with that. There is an introduction where they talk about what does the FRBM Act say. So that itself is there. When did it come into force? The FRBM Act mandates the central government to limit the fiscal deficit up to 3% of GDP by 31st March 2021. That continues to be what the FRBM Act says. That is the FRBM Act, that if fiscal deficit should be reduced to 3% of GDP by 2021. It further provides that central government shall endeavor to limit the general government debt to 60% of GDP, general government debt, and central government debt to 40% of GDP by 2025. That is what it continues to say. That's all. Okay. But they are giving further as to what the government said. The government has retained its fiscal deficit target at 4.4% of GDP. That was what they had given in the budget estimate. In the revised estimate also, they have retained, that is what they are saying, because they believe that they will be able to meet it by the end of the year. Further, in line with the commitment made in the budget speech and the fiscal consolidation path presented in the budget, the fiscal deficit to GDP is projected at 4.3%. What is the what is the commitment made in the 2021-22 budget? By 2025-26, they will reduce the fiscal deficit to less than 4.5% of GDP. They had made a commitment in 2020-21 budget. February 1, 2021, they had made a commitment saying by 2025-26, we'll reduce the fiscal deficit to less than 4.5%. So 4.4 is very much less than that. So they are on track to fulfilling that commitment. Okay, that is what it says. And the fiscal consolidation path presented in budget of 2025-26. What fiscal consolidation path are they talking about? Revenue, is it? They didn't give a fiscal deficit target. No. What is the current target? Is with respect to central government debt. Central government debt. Okay, that is what they are referring to with respect to fiscal consolidation path presented in the budget of 2025-26. They said by 2031 we will reduce central government debt to 50% plus or minus 1% of GDP, and we will ensure that fiscal deficit is at such a level where every year the central government debt is reducing to reach the target of 50. So compulsorily every year central government debt should reduce. It's not a direct target of 50. Every year they should try to reduce the central government debt in a gradual manner. How much every year they have not said, but every year it should reduce. And fiscal deficit would be kept at such a level where it is enabling the central government debt to be reduced. Now, a fiscal deficit of 4.3%, which is projected for next year, will help us reduce the public debt by whatever extent, which means we are in line with the fiscal consolidation path presented in the budget of 25-26 as well. Okay, so this is what that statement means, that they are recalling, they are connecting with the previous commitments that they have made and showing that they are sticking to the commitment. Okay, what does this document contain is what is given. This is where we are going to discuss. There is a total of 14 paragraphs. We are going to look at most of them. And that is all with respect to detailed looking at paragraphs. That is the only thing that we are going to do. This is the last detailed analysis that we are going to do, paragraph by paragraph. So global economy, these are points that could be very, very useful from the mains exam perspective more than prelims exam perspective. Information that you can take. This is the source for it. You don't have to memorize it now, but eventually when you start preparing for your main specific answer writing practice, you can come here and get the data. Global economy continues to be resilient, projected to grow at 3.3% in 26 and 3.2% in 27. So this is the global GDP growth rate, global average of GDP growth rate. The entire world is growing at the rate of 3.3% in comparison to the previous year. 3.3, 3.2 it is projected to be. What is India growing at? 7.4, which is there. Soon after that it will be here. As per the first advance estimate published by NSO, India's real GDP is estimated to grow by 7.4%. So we are growing more than double the global average. Doesn't matter. It is, everything is in terms of, IMF has said the same number. So even if you convert it into US dollar terms, it doesn't change. Get out of the critical outlook. Okay. So that is the real GDP growth rate. Nominal GDP growth rate is 8%. Inflation has been very, very low over the last year. Okay, we'll see what the inflation level has been as well. Okay, there's a general comment about the global scenario continuing to be uncertain. These are words and phrases that you can quote in your mains answers. Look at this. While the current economic stability reflects a balance between surging sectoral investment and shifting trade policies, this equilibrium remains precarious, which means it could change anytime. Any uncertainty could come into the global scenario. Growth prospects continue to be vulnerable to geopolitical escalation and renewed trade tensions, both of which threaten to disrupt global flows. These are the words that you could pick some of these words and insert it into your answers, provided you know the meaning to what you are writing. But it will enhance the value of your answer because these are phrases of the government itself, okay, which will help you add value to your answer. Okay. Aligning fiscal discipline. What is fiscal discipline? Fiscal deficit and public debt targets. That is fiscal discipline. If you are saying this is what we are going to spend, spending only that much. If you are saying this much we are going to collect as tax, ensuring we collect that much tax. That is fiscal discipline. Aligning fiscal discipline with growth friendly investments, which means we should not compromise too much on borrowing. In the attempt at maintaining fiscal discipline, we shouldn't completely give up on borrowing. We should borrow for the right purposes and use it in the right manner. Aligning fiscal discipline with growth-friendly investments is seen as necessary to insulate the economy against adverse global shocks. This is the basic introduction, comparison of domestic economy or the link of the domestic economy with the global economy. So the first macroeconomic analysis that we are doing is with respect to the global economic environment. Then we get to the domestic economic developments. So economic growth rate we discussed. Except agricultural sector, all other sectors have witnessed an increased growth. Agri also has grown, but agri's growth of 3.2%, I think. Yeah, here it is given. Service sector remains primary growth driver, expanding by 9.1%. Its growth rate, the nation's growth rate is expected to be 7.4, but services expected to be 9.1%, which is growing more than the national average. And manufacturing construction growing by 7, slightly less than average, but more or less on track. Agriculture is estimated to grow by 3.1%, which is lower than the previous year. But our intended growth rate itself is only 4% when it comes to agriculture. So don't compare it with 7. This is a mature sector. We cannot possibly, with the current level of technology and mechanisms that are there, investments that are there, we cannot grow at more than 4. We are not even targeting that. If you are able to grow by 4%, agri is considered as a success in India. Mature sector, right? Attained that level of growth already. Agri already grew by that 7 or 8% during the Green Revolution and the immediate aftermath of that. Okay, so 3.1 is not a big disappointment, but it is lesser than what we were growing in the previous year. That is the only thing. We are growing, but by slightly lesser margin. That's all. Except for agri, all other sectors recorded higher growth than previous year. But they are very positive about agriculture because monsoon has been good, output has been good, productivity has been good. So that is the general conclusion that we have with respect to that. Procurement and buffer stocks remain adequate. So food security is there, government has sufficient buffer, we'll be able to deal with price surges and all those things. That is the positive conclusion that we have. With respect to consumption and investment, both of them are showing a positive trend. You remember the formula for GDP expenditure method? C plus I plus G plus X minus M, correct? Of which C is technically referred to as? Technically. Private final consumption expenditure. G is government final consumption expenditure. Both are consumption expenditures. So by consumption, they are referring to both private as well as government. The consumption expenditure contributes roughly around 61.5% to GDP, which in the past has been around 60%. We are seeing an increase, which is in line with what used to be. It is the highest since 2011-12. The contribution of private final consumption expenditure of 61.5%. So there had been a slight decline. Consumption pattern had been showing a slight slowing trend, but we are now back to consumption contributing significantly to GDP. The positive sign here is that India is not very hugely reliant on other countries' consumption for our growth, which might also be a good thing, export related growth, as long as export is diversified. But we are at least not Atma, opposite of Nirbhar. We are not that. We are Atma Nirbhar. Okay, whatever the opposite of that is. So we are Atma Nirbhar in terms of the ability to grow, because demand is what drives growth. Okay, and the demand is coming domestically, which means we are not as prone to external shocks as say a country like China might be, because where their major driver itself is export. Okay, so government final consumption expenditure estimated to strongly rebound. High frequency indicators such as UPI transactions. What is meant by high frequency indicator? What is meant by high frequency? Very frequently. So you know that on a daily basis how frequently we do transactions on UPI. They are using that as a parameter of measuring how effectively consumption is happening. Okay, so high frequency indicators like UPI transactions, air and rail traffic, e-way bills. What are e-way bills? GST for transporting commodities from one place to another. Those are e-way bills. Those are very frequent. So when rail and air traffic, also road traffic, your toll collections could also be a high frequency indicator. So they've given etc. No, reflects sustained momentum in both urban and rural consumption. Okay, shows that India's economy with respect to consumption is doing fairly well. Investment activity is also quite good, but more or less stagnant. The GFCF, gross fixed capital formation, accounts for around 30%, which has been the trend throughout. Okay, we would ideally want more investment, but even if it's not happening increasing, it is not decreasing. That is also that they are projecting it in a positive side. They are not saying that it is not growing, they are saying it is remaining stable. Okay, so has remained stable at around 30% GDP for past 3 years. An opposition would criticize it as saying no improvement in GFCF. They are saying we are attaining stability. What more do you need? Okay, with external sector, they have given total exports. The value of that is given quite not great. We know that we are running a trade deficit, right? So that is there, as you can see with import numbers. Have they given here? Despite tariffs imposed, merchandise exports have imports. They have given that in absolute number, but they have given this as a percentage. So despite tariffs imposed, merchandise exports grew by 2.4%, but merchandise imports grew by 5.9%. So obviously that explains the gap of imports being greater than exports. But that is inevitable in a country where predominantly domestic consumption is driving. So there will be imports of commodities as well. Service exports increased by 6.5%. Gross foreign direct investment recorded a net inflow, which is a positive thing. But look at how subtly they have mentioned this other point. A net portfolio investment outflow of 3.9 billion was recorded from April. No comment on that. Because net outflow has happened, the excessive depreciation has scared the investors a little bit, portfolio investors. So there has been a net outflow, which means it's a minus account there. Usually FDI, FPA loans all are positive accounts in net terms, but FPA has recorded a net negative because of excessive outflow. Depreciation makes them take their money and go, but them taking the money and going is causing further depreciation, like a self-propagating cycle. Okay, so this is what we call as capital flight. Prelims, the fact that FPA is going outside, its impact on exchange rate, depreciation's impact on FPA, all of these are possible questions because it is regularly happening. And also RBI's intervention. Because of this excess FPA outflow, RBI, which usually refrains from intervening in the currency market, has taken money from its forex and supplied it into the market. RBI generally refrains from intervention, but it has had to intervene. If it had not intervened, today $1 might have been equal to 95 or even more than that. RBI intervention has prevented the or reduced the extent of slide that is happening. Okay. There is a comment about current account deficit. It says current account deficit declined to 0.8 from 1.3. However, it's only half year data. You can never rely on half yearly or quarterly data with respect to any of these things, because sometimes what happens is in the first half we may not import much. It might be in the second half that we import to a greater extent. There might be a regular pattern. In fact, you might see in some quarters India even has a trade surplus in quarters, if you look at quarterly data, because in that quarter we are not importing much of whatever we are importing. There might be seasonal factors that come into the picture. So the half yearly quarterly data is always misleading. So don't go by just this. Wait till March is over and RBI will give a complete data before your prelims with respect to what is the trade deficit, what is the balance of payments picture. Sometime in April you will find that should be your source, final source of trade related information. This should not be your final source of that. This is just an indicative thing. Only for 6 months or 9 months they have given. Okay. Wait till April, you will get RBI data with respect to BOP related stuff. So that should be your final source of data with respect to that. Prices and inflation. Inflation is at an all-time low. When I can't say all time, but at least over the last 10, 20 years, this inflation, this low level of inflation we have not witnessed. 1.7% is what we have. 4.9 in the previous period, and we are expecting annual inflation of 2% for 25-26. 25-26 is over, no? So that is what they are ultimately expecting it to be, and 4% for the first half of 27. Okay, 4% is what is the ideal target, ideal value for us. So that is okay. They are saying it will be 2% because it is within the band, no? 2 to 6. It is within the band. 1.7 is below the band, which means they have to take action. So they are projecting that by the end of March, it will get back to an average level of 2%. So that is how it is. Then there is a discussion about financial and capital markets, where money can come from. So they have made a mention about mutual funds, industries, assets. Since the government itself has made a comment on that, please read up a little bit about mutual funds, different forms of that, because the government is making statements about mutual funds as a significant source of funds. So read up a little bit whatever you can about mutual funds, how they work, or different types of mutual funds if there are any. Already they are asking questions of that nature. Alternate investment funds, they have asked a question. So just have a general awareness about that region. With respect to banking sector, India's banking sector is having an all-time great performance with respect to NPA. Again, all-time is very subjective. At least in the last 12 to 15 years, this low level of NPA we have not witnessed. So 6% and above of NPA is danger for an economy. Any average NPA of more than 6% for the economy is bad. Our NPA is only around 2.1%, the average NPA, which means we are performing really, really well with respect to our banking sector. Also indicated by the capital adequacy ratio being around 17.2%, where the target even for the risky banks is only 12%. For the safer banks, it's only 9%, but India is maintaining an average of 17.2, which is actually a very good number. Again, if you are not familiar with capital adequacy ratio, NPA, these might just be numbers which doesn't mean anything to you. Okay, so you'll have to go and come back to the statement after you go and revise what is meant by an NPA, what is NPA ratio. NPA ratio is nothing but total NPAs divided by the total assets given. But then next question is, what is NPA? What is a non-performing asset? Loans given by the bank that the bank has not been able to recover. If a bank has given a total loan of 10,000, of which 1,000 rupees they are not able to recover, then 10% is their NPA. Okay. When we say 2% is their NPA, out of the 10,000 rupees they have given, they have not been able to recover only 210 rupees. Okay, which means they are in a safe position. Up to 600 rupees of inability to recover, we are saying is okay. Every bank will have that. Anything greater than that is the danger sign. We are nowhere close to being in the danger area. Similarly, to deal with these risky assets, every bank is expected to maintain some reserve, some kind of capital. That is what we refer to as capital adequacy ratio. Do you have adequate capital to deal with the risks in the system? Okay, and there are benchmarks given. Whatever is the risky asset that you have, at least 9% of it you should have in the form of asset. For some banks it's 12. Indian banks are having 17% of that in the form of capital, which is a very good sign again. Okay. Okay. There is also a comment on the monetary transmission mechanism. The RBI has cumulatively reduced repo rate by 1.25 percentage points or 125 percentage points since February 2025. RBI has reduced the repo rate. Now the question is, RBI is reducing repo rate so that banks can give more loans to the people. Are banks now giving loans at lower interest rates? Yes, they are. They have reduced their average lending rate by 69 basis points, which means 0.69, which is not ideal. RBI reduced it by 1.25, they are only reducing it by 0.69. Okay, but at least there is some reduction that is happening, because banks also have to take into account the risk of the loan given, right? RBI's repo rate is between RBI and bank. RBI doesn't have to worry about bank taking the money and running away. But when a bank is giving loan, they are giving loan to people who might not have the ability to repay. So they might have to charge a higher interest rate on them. So it is only expected that when they reduce it, bank won't reduce by the same extent, because RBI is giving loan to bank is giving loan to general public. Okay, but the fact that they have also reduced the lending rate by a significant portion shows it's good sign that loans are available for businesses if they want to borrow. Monetary policy is actually transmitting from the RBI to the bank and from the bank to the people to some extent, even though it's not ideal, it's not perfect. So that is what it says. Then public finances, we have already discussed, everything is in line with government set targets, and the overall outlook is that one significant point is the country received 3 sovereign rating upgrades during the year. What is sovereign rating upgrade? International agencies giving credit rating to governments across the world. Okay, like Moody's, Fitch, there are, yeah, CRISIL is Indian, no? So there are such S&P, Standards and Poor's. There are some international organizations like that which give credit rating to countries itself, like domestic ICRA and all those giving credit rating to individual companies. International agencies give credit rating to countries, and India's credit rating has received 3 upgrades. That is what is sovereign rating upgrades during the year, which means people are trusting India more and more. India's credibility is increasing more and more with respect to repayment capability, with respect to its stability, with respect to finances. All of these are factors, which is a very positive sign when it comes to India. India is looked at positively globally, is what we conclude. But you can take this particular point and write it as a measurement of good performance of India, good performance of the government and of the Indian economy itself. Okay, so that is a point that you can take. The general point, India's growth outlook remains positive, supported by strong domestic demand, structural reforms, and a stable macroeconomic environment. This is your introduction line. While talking about Indian economy, introduction to Indian economy, this line you write as it is. This is a substantiation line. Proof of the first statement is given there. Okay, this entire paragraph you can take as it is. Inflation outlook remains benign, which means mild. Continued public investment, deregulation, labor market reforms, human capital investment, tax reform, 1 mark for every point. Digital transformation, formalization of economy, all of these are things that are happening in India, right? And all of these are points that you should know as well. You should represent in your answer as well. Each of this is a very important point. And in each of these points, you should go and inspect. What do they mean by public investment? Where is it happening? You see all the roads, ports, harbors, all those that are built. Deregulation, what is happening? What is deregulation? Opening up more FDI coming in, labor laws becoming more relaxed, or farm laws becoming more relaxed. That is what is deregulation, that is happening. Labor market reforms is obviously the labor law changes that have happened, or even the current gig economy alterations that have been done. All of those are labor market reforms. Human capital investment, more skilling, your Skill India program, all those things. Then tax reforms, direct tax, indirect tax, all those reforms that have, GST especially. Digital transformation, the transition towards digital India, formalization of economy, the gig workers also being brought into the fold of social security and all those things. All those are, so you have to go into each of these headings and dig, okay, what can I write as an example to substantiate this? So it will stay in your mind for longer as well. These points are very, very important from the exam standpoint. Okay, are expected to drive the economy to higher growth trajectory as indicated in the survey. Strong balance sheets of corporates, financial sectors expected to drive virtuous cycle of growth. The words I can use, virtuous cycle of growth. USA risk is there, but still we are able to diversify by shifting to other tariffs or other sources. Trade diversification, same point, is very, very important. And Some areas that they should, India's economic fundamentals provide a solid foundation for continued progress, but global uncertainties, energy transition challenges, because we have taken up the Paris Climate Agreement challenges and other general challenges by 2070, net zero carbon by 2074, is it 75? 2070. So that is the energy transition challenges. And in today's newspaper or something, we have a discussion about vehicles. Government is trying to transition more vehicles to hybrid mode or electric mode by disincentivizing even small cars having petrol, diesel. Okay, those are there as part of energy transition challenges. Domestic policy certainty and predictability and private sector short-term focus, there are areas to watch and improve. I went through all of these 14 paragraphs for the simple reason that this will give you a big chunk of your mains answers when it comes to Indian economy, writing with respect to Indian economy. Not as important from the prelims perspective, because the other documents, the terms that is there, that is where prelims focused questions will or areas will be. This is all with respect to adding points to your mains answers. This document, this 14 paragraphs, if you can read it and understand it properly, not memorizing it, but reading and understanding properly, will add value to your mains answers. Okay. That is one document. That is a macroeconomic framework statement. That is a macroeconomic framework statement. This is a summary of that with respect to various performances. And now we have the medium term fiscal policy, fiscal policy strategy statement. Medium term fiscal policy is very simple. This is all. Okay. In the past, there used to be a 3-year timeline. This year, next year, the year after that. What is the fiscal policy? What are these 6 parameters going to be like? But of late, after the FRBM itself has not been followed, we don't have specific targets to meet in a 3-year or a 5-year timeline, right? So they are not giving year-to-year targets. They are only giving next year what is our target going to be. So medium term usually refers to 3 years or so, but although it is called medium term, they are only giving immediate next year targets. When FRBM was originally introduced, they used to give rolling targets for 3 years, for the next 3 years, and then for the next 3 years, and then for the next 3 years, and so on. They are not doing that now. So fiscal deficit target, revenue deficit target, primary deficit target, tax revenue as a percentage of GDP. How much are they hoping to? It's 11.4. It is estimated to be only 11.2. It's going to reduce a little, but they are explicitly saying so. Non-tax revenue and central government debt. These are the 6 parameters that they are using to measure how India's fiscal performance is, government's fiscal performance is. That's it, just one document. It's a further expansion of that. No, it's the same document. No, medium term fiscal policy strategy statement, where fiscal policy strategy starts over here from the 5th paragraph onwards. It further explanation of what the various reasons for taxation, how they are going to get the taxes, how they are going to spend, and all those things. We are not going to go through that. Just the amount of money that they are getting, what percentage, and all those, just numbers. And what else is relevant over here is the final discussion, which is an explanation of why FRBM is not going to be stuck to. This one, conclusion and policy evaluation. A statement explaining the reasons for deviation from the fiscal targets mentioned in section 4 and compliance obligations under section whatever of FRBM Act. So this is something that whenever they fail to meet FRBM targets, the government must explain their failure to meet the FRBM target. So this one explains that part. Okay. Again, there is nothing new here. It's almost a repeat of the previous year. Global uncertainties, COVID, all these contributed in us deviating from the target. It is practically not possible to meet the FRBM target right now. So we are keeping ourselves a slightly different target with the objective of meeting the target, provided nothing new comes up. Okay, that is how they are concluding this. So this is the FRBM document. That's it. Just one more document, and then this document, there is nothing much to teach per se. Budget document, key features, just be introduced to this, 23 pages. This note itself, this document itself is a notes of the budget, the key points of the budget, key features of budget. India's economic trajectory, again, words that you can use in your mains answers. Just download this and go through this document itself rather than making notes from this. Okay. So these are 4 key focus areas for the government: to provide stability, to ensure sustained growth, There should be fiscal discipline and moderate levels of inflation. High growth rate of around 7% is to be achieved with certain objectives: reduced critical import dependence, far-reaching structural reforms. These are all general objectives that the government has in mind. Fiscal prudence will be ensured, monetary stability would be there, strong thrust on public investment would be there. So whatever we said earlier, saying in the just concluded document, we said the government is doing all of these things, that is just given in pictorial form. Okay, we'll just be repeating ourselves if we go further into it, but there are some substantive areas that you have to take from this as well. So Yuva Shakti driven budget, so government's intention, resolve, and they say there are 3 objectives or 3 duties that the government is giving itself. First Kartavya, second and third Kartavya: accelerate and sustain economic growth, that's the first. Second is fulfill aspirations of people, and third is vision of Sabka Saath, Sabka Vikas. But all these are just like mission statements or vision statements of the government, It doesn't quite explain how they are going to go about it and all those things. That will come a little later. They're still saying build people's capability, but not how. That will come later. Okay. There is a discussion about what the various pillars of growth are. These are again general headings into which you can classify your answers. Now we go into one of these, one by one. Sustaining economic growth, we wrote here, right? Accelerate and sustain economic growth, then fulfill aspirations of people. We are going further into how these duties are going to be fulfilled. So sustaining economic growth, manufacturing sector, strategic and frontier sectors, what are they going? So in the scheme, when I showed you, they introduced something called as Biopharma Shakti. Okay, so India Semiconductor Mission or chemical parks. So whatever we saw in that budget, this is the place from which you can go there. So you look at this. Okay, there is a scheme here. What about the scheme? You have to go to the concerned ministry. So the source for you for all of this would be any scheme. Either you can go to the concerned ministry, but if you don't know, just type PIB, Press Information Bureau. You will get to read a general overview of what that scheme is about, what is their intention. In most of these schemes, the government has not yet detailed how they are going to go about it. So we may not yet be in a position to go through and understand in depth of how these schemes are going to be implemented. With time, the government will announce, give notifications as to how they are going to go about implementing these kind of mechanisms that are there. So we can't really discuss much more than what is explicitly given over here. Tax reforms to boost. What are the various tax reforms that they have given? There is a big list of tax reforms that is there. Just go through it and see what you can remember out of these. Okay, there are some very, very specific and minute things such as duty-free imports of specified inputs extended to export of shoe uppers in addition to leather or synthetic footwear. These are very, very minute and very difficult to remember things. Don't focus on those areas. Focus maybe on greater extent of maybe something like this. Regular importers with trusted long-standing supply chain to be recognized. The special one-time measure to facilitate sale in domestic tariff area at concessional rate of duty by eligible manufacturing unit of SEC, because there is some logic here. An SEC usually means they cannot sell domestically. They have been given a lot of tax benefits, but with the condition that they must export. But what if they are not able to find a suitable export market? So there is some kind of a relaxation that they are doing. This is promoting manufacturing. Okay, so anything, I just gave 2 examples as to what came to my mind as something that can be remembered, but that will vary for you. Whatever you can connect with in this, out of say 10 or 12 that they have given, 1 or 2 if you can remember, those can be tax reforms that you can remember and reproduce. Okay, 3-pronged approach to help MSMEs grow as champions. You must, this page, very, very important. You must learn all about it, because MSME is a very, very regular area of questioning when it comes to mains, and any terms that you come across here like TREDS, what is that scheme about, or what is it about, how does it work, if it's about a billing submission and all those things, how does it work, can be a prelims question as well. How trades work, okay, or what is meant by this SME growth fund, or what is meant by corporate mitras. These are terms that you should go a little deeper into And as and when we get more information about it, some of them we don't yet have full information on, some of them we'll have more information about in due course. Okay, that we'll have to update ourselves with, because MSME is compulsory, very, very important area, especially when it comes to mains examination. Okay. Emphasis on service sector, but what are all they meaning by service sector? There is employment and enterprise, health is there, service sector, health, care ecosystem. For each of them, there are different areas of focus that is given. Again, these are predominantly like headings, but in some cases they are very specific. So 3 All India Institutes of Ayurveda, upgrading Ayush pharmacies and all those. So this is about alternative medicines that is there. So if there is an area of discussion with respect to that. So again, don't blindly memorize any of these things. Look at syllabus. In syllabus, where can you fit in? Okay. In syllabus, where can you fit in? As an example, try to remember these things. From a mains perspective, once again, unless there is some detailed news about this or it's regularly in current affairs, maybe not as important from the prelims perspective. So this is again continuation of that. Service sector, education, tourism, very, very minute things. So girls hostel in every district, telescope infrastructure facilities. These are very minute things, but these can be written as measures that the government has taken for social inclusion or service sector growth and all those things. Tax reforms to boost service sector. Earlier we saw tax reforms to boost manufacturing sector. Here is a list for service sector, and then there is financial sector itself. With respect to foreign exchange management, with respect to public sector enterprises, their ability to generate finances, tax proposals, this very minute again, it's only about securities transaction tax. But because securities transaction tax is given so much of focus, at least know the very basic idea of what is meant by securities transaction tax, and in general what those rates are like. Look at the rate of securities transaction tax, 0.05% on the value of a transaction. Okay, which is not even 50 paise, it's like 5 paise would be the 0.05 by 100, right? Yeah, so it will be 5 paise, it will come to 5 paise as a tax for a transaction of say 1 rupee. That is how low this tax is. So have a general idea of what this rate of tax is looking like. How to increase farmers' productivity? Again, they have a flow chart of what all the various areas that is on focus for farmers. Again, these are intentions. We will probably come across more with respect to agriculture, manufacturing and services in the economic survey. So there we'll have more substantive information with respect to what are the proposals that the survey is giving to the government to do, how the economy should proceed and all those. That would be a better place to get all of these things. And tax proposals for agriculture. So 3 sectors: manufacturing, service, agriculture. What are the objectives that the government has or schemes that they have? What are the tax reforms that they have in place? That is given over here. Strengthening the foundation of growth with respect to infrastructure, stability and security with respect to power, how to urbanize the cities. So focusing on tier 1 cities are the ones that are already in the form of cities. Tier 2 and tier 3, how to make them into better cities, more how to improve the connectivity over there. So that is what they have given. People-centric development, what we said earlier, the 3 kartavya, it is again aligned with that. So people-centric development, how to go about doing that. Trust-based governance, these are headings. So again, these headings can also be looked at as how you can structure your answer with respect to the role of governance in improving the nation. Categorize into these headings: ease of doing business, ease of living, and the heading that was there before that. Fiscal matters, we have already discussed the Finance Commission and fiscal consolidation targets that is there. This rest of it is, I think it's only with respect to budget. Yeah. This is where they have the major expenditure items in crore. This can be very useful as well. How much money are they spending on transport, defense, rural, home affairs? We have seen this already in the budget document, but not in this pictorial form, just as numbers. Okay. So you asked earlier when a question, how do they decide how much? Then whatever table we're discussing, that same data is given over here, but in a probably more attractive looking manner. So this is the key highlights. There is very little that you can sit and learn from this or understand from this. This is just going to act as a guide for you to go and learn more about this particular area. Agree? Go to the economic survey, that will give you more information about it. Manufacturing as well as services, the same thing is what is there. Just have a general structure of what the government intends to do with respect to the budget. Okay, so with that, we'll conclude the class. If you have any questions you would like to stay back and ask, you can ask. If not, you can leave. Thank you. Welcome people online.